Yes, my dear students. So friends, we are done with discussion about the concept known as Introduction to Income Tax, where we learned some basics of income tax in terms of understanding what exactly is tax. Come on, what is that we learned in this topic? We clearly understood what exactly is the meaning of this word called tax. We clearly discussed what is tax. First of all, tell me, my dear friends, what is tax? Tax is a compulsory fee charged by the government. And there are two types of taxes called direct tax and indirect tax. Direct tax is the tax where impact and incidence is on same person. Indirect tax is the tax where impact and incidence is on different person. And what is Article 265, my dear friends? No tax shall be levied or collected except by authority of law. Then post that we discussed that Constitution in 7th schedule, they have given three lists. What are three lists they have given? Union list, state list and concurrent list. Union list contains those matters on which power is there with central government. State list contains those matters on which power is there with state government. Concurrent list contains those matters where power is there with central and state together. And income tax is governed by entry number 82 of Union list of 7th schedule to the Constitution of India. And we have clearly discussed what are the 5 sources of income tax law. Tell me, my dear friends. So friends, what are the 5 sources of income tax law? Income Tax Act 2025, Income Tax Rules 2026, Annual Finance Act, Circulars and Notifications, Judicial Pronouncements. So that's the interesting aspect with respect to what are the, come on my dear friends, what are the sources for income tax law. Then after that, my dear friends, we clearly understood in terms of the various definitions what we have in income tax with respect to definition of India, definition of person 277, then 211 which defines who is an assessee. Come on my dear friends, by the way, who is an assessee? Assessee means any person who is liable to pay tax and includes every person in respect of whom proceedings have been taken up for assessment of his income or income of any other person in respect of which he is assessable, or loss sustained by him or such other person, or refund due to him or such other person. And assessee also covers somebody known as deemed assessee. And last point, assessee also covers assessee in default. And who is covered in assessee in default? There are 3 cases which are covered in assessee in default. Come on friends, assessee in default covers 3 cases. Number 1, person who has not done TDS. Number 2, person who has done TDS but not paid to government. Number 3, person who failed to pay advance tax. These 3 are covered in assessee in default. Then after that, my dear friends, we have spent some good time on discussion about section 202 and also optional tax regime. What is section 202, my dear friends? Section 202 deals with the concept of default tax regime. And in default tax regime, what are the tax rates, my dear friends? There is no category called normal, senior, super senior. Directly the tax rates are up to 4 lakhs nil, 4 to 8 5%, 8 to 12 10%, 12 to 16 15%, 16 to 20 20%, 20 to 24 25%, above 24 lakhs 30%. So every 4 lakhs 5% is increasing. Then in optional tax regime, the rates of tax are based on age criteria: normal, senior, super senior. Normal below 60 years and senior 60 to 79. Super senior, my dear friends, 80 and above. Those are the 3 categories with respect to normal, senior, super senior, which we have clearly understood with respect to the provisions of the tax rates for individual HUF, AOP, BOI, AJP, and separate tax rates there for other persons. Then after that, we have also covered tax rate under 196, 197, 198, which talks about capital gains. Even that special rates of tax also we have covered. So that's the story of your first topic, introduction and basics, where we have also understood that section 13 clearly says that there are 5 heads of income, and all 5 heads of income combined together, what we get, all 5 heads of income combined together, what we get is known as gross total income. From the gross total income, we reduce deductions under chapter 8. Once we reduce deduction at chapter 8, what we get is known as total income. On total income only we will compute what is the tax payable. And what are the 5 heads of income, my dear friends? Income from salaries, income from house property, profits and gains from business or profession, income from capital gains, income from other sources. And moreover, interesting point is that if any income is taxable and it is not covered by first 4 heads of income, then it will automatically come under income from other sources. That is an interesting point to be noted. So when all these 5 heads of income we combine, what we get is called gross total income. From that we take deductions, then the balance is called total income. Very, very interesting point. Now it's time to learn the next interesting topic in our syllabus is, my dear friends, residential status. Come on friends, what is the topic name? Residential status. Now what is residential status? First of all, let me write first and foremost important point. Taxation of any income. Come on friends, what is the line? Taxation of any income is not based on citizenship. Instead, it is based on residential status. Taxation of any income is not based on what, my dear friends? Citizenship. So, citizenship is not the criteria to determine residential status. That is the interesting point you have to note. Come on, what did I just say? Citizenship is not the criteria to determine residential status. And citizenship is not the criteria to determine the taxability of any income. What is the criteria is only residential status. And the point to be noted here is that in case of an individual, in case of whom, sir? Individual. In case of an individual, residential status is determined based on duration of stay in India. This is one interesting line. Come on friends. Residence status determined based on what, sir? Duration of stay in India. How long you stayed in India, based on that we will decide whether you are resident or you are not a resident. And duration of stay in India, India means what we already know. India covers territory, territorial waters, seabed and subsoil underlying such water, continental shelf and exclusive economic zone and any other maritime zone, and also covers airspace above territory and territorial waters. So this is what is technically covered in definition of India. So how long you stay in India, based on that we will decide what is the residential status. Understanding, my dear friends? And in this particular topic, my dear friends, the residential status is determined based on provisions of section 6, my dear friends. Section 6 deals with residential status. Based on that parameter, we will decide whether a person is a resident or a person is a non-resident. And one more point is, residential status may change every year. Obviously, my dear friends, because year on year, 1 year he may be resident, 1 year he may not be a resident, for a simple reason, because we are deciding based on number of days in India. So 1 year he might be for more days, 1 year he might be for less days. Based on that we will decide. Friends, correct or not? Come on, see here now. One interesting point I will tell. Sir, for residential status, I divide the person into two categories. One category is called individual or HUF. Other one is any other person. Now, why did I divide like this? There is a logic behind this. Let me explain that to you. In case of individual or HUF, my dear friends, there are three interesting categories. First category is known as resident and ordinarily resident. So the word used is, it is not resident and ordinary resident. It is resident and ordinarily resident. Ordinarily means usually, generally. So ordinary means not ordinary. The word is not ordinary. The word is ordinarily. That means usually, generally. Resident and ordinarily resident. In short, we call it as ROR. Second category is called resident but not ordinarily resident. Come on, what is the first point, my dear friends? Resident and ordinarily resident. Second point is resident but not ordinarily residents. In short, we call it as RNOR. What is the first one? Resident and ordinarily resident. Second point is resident but not ordinarily resident. And the third point is known as non-resident. What is the third point, my dear friends? Non-resident. So for individual HUF, there are three categories, my dear friends: ROR, RNOR, NR. ROR, RNOR, NR. ROR stands for resident and ordinarily resident. RNOR stands for resident but not ordinarily resident. NR stands for non-resident. But in case of any other criteria, my dear friends, when I say any other person, what is the possibility? Firms, local authorities, LLPs, companies for that matter. In these cases, we have only two criteria: resident, other one is non-resident. That's it. We have only two categories: resident, non-resident. There is nothing called ordinarily resident, not ordinary resident. Understanding, my dear friends? Come on, repeat. In case of individual or HUF, there are three categories, my dear friends: resident and ordinarily resident, resident but not ordinarily resident. The third category is known as non-resident. In case of any other person, there are only two categories: resident and non-resident. And for individual, I clearly told you, we will decide based on duration of stay in India. And based on type of person, we will decide which income is taxable, which income is not taxable. Let's get clarity on residential status. Then we will go to section 5, scope of total income, where we will understand which income is taxable, which income is not taxable. Are we all clear, my dear friends? Everyone, sir. Make sense? Wonderful. Come on. Get back. Residential status and scope of total income. People have always traveled across borders, and wherever they settle, they earn income that ultimately has to be taxed. Every country writes its own tax rules. Indian tax law first fixes the residential status of a person to decide how they will be taxed, and then fixes the scope of their income based on where that income is earned or received. So in this chapter, what we are going to learn is how to determine residential status, cases where a person becomes a deemed resident. He is not a resident, but he is deemed to be a resident. The concepts of accrual and receipt of income, and we will also understand the concept of classifying a person's income as Indian income or foreign income. What is that? That also we will talk in detail. So friends, the taxability of income always depends upon two important factors. Number one, residential status. Number two, the time and place of accrual or receipt of income. So there are two important parameters, my dear friends, to decide the taxability. I repeat one more time. There are two important parameters to decide the taxability. Number one, residential status. Number two, the time and place of accrual and receipt. Where the income is accrued, where the income is received. That is one parameter. Other parameter is residential status. So based on these two parameters, we will decide which income is taxable, which income is not taxable. Are we all clear, everybody? All of us? Done. Let's proceed. Residential status. Which section, friends? Section 6. Taxability of any receipt depends not only upon the nature of income and place of accrual or receipt, but also on the assessee's what status? Residential status. Next line. Residential status is determined separately for each tax year. Every year will determine separately, my dear friends. A person may be a resident in one tax year and a non-resident in another tax year, or vice versa. Next line. Important points. A residential status has nothing to do with citizenship, place of birth, or domicile. Domicile means where he is usually staying. The citizenship of India, a citizen of India may be a non-resident and a foreign citizen may be a resident, because we are clearly going to decide based on duration of stay in India. The term tax year and income tax act replaces both previous year assessment year. Already we know that. And tax year is a period of 12 months. And tax year 26-27 means what? April 26 to 31st March 2027. Already we know this. Section 3. Tax year. Done now guys? Come on. Now let me talk about the residential status of an individual. How do we determine the residential status of an individual? Please see that. Section 6.2 contains basic conditions. What conditions are? Basic conditions. And there are two basic conditions, my dear friends. Number 1, he must be in India. Sir, when I say he must be in India means what? Physically be present in India, not online, virtual, AI. He must be physically present. He must be in India for a period of 182 days or more during the previous year. Come on friends, what is that line? He must be in India for a period of 182 days or more during the previous year. Let me repeat one more time. What is the concept I just told? He must be in India for a period of 182 days or more during the previous year. When I say previous year concept is not there now. So I'll write the word as during the tax year. During the tax year, he is in India for a period of 182 days or more. So for example, sir, if you are taking an example like this, let us say tax year is 26-27. That means 1st April 26 to 31st March 27. In this period, if he is there in India for greater than or equal to 182 days, we will treat him as a resident. And don't get it out, sir, what will happen if he is a resident? What will happen if he is not a resident? That we'll talk in detail, don't worry. Next, other side. Second possibility is, he must be in India for a period of 60 days or more during the tax year, and 365 days or more during 4 years. During 4 years preceding the tax year. Preceding what, my dear friends? Tax year. Come on, let me repeat again. What is the first possibility, my dear friends? He must be in India for a period of 182 days or more during the tax year. Second possibility is he must be in India for a period of 60 days or more during the tax year and 365 days or more during the 4 years preceding the tax year. And the interesting point is, if any one of the basic condition is satisfied. What is that like? If any one of the basic condition is satisfied, then he is regarded as resident. Else he shall be regarded as non-resident. Else he shall be regarded as what, my dear friends? Non-resident. If the person is resident, I repeat one more time. If the person is resident, we will see further clarification. That is, we will see further bifurcation of ordinarily resident, not ordinary resident. So the story of ordinarily resident and not ordinary resident, it will come into picture only when, first of all, a person is a resident. First of all, when person is a resident, But starting stage itself, if we decide that person is non-resident, the story ends then and there itself. Starting only if we decide that a person is a non-resident, the story ends then and there itself. There is no second thought about it. Are we all getting clarity, everyone? So please reply. Come on, my friends, get back. So 6.2 talks about what? Basic conditions to determine residential status of an individual. What are the two conditions? Number one, he must be in India for a period of 182 days or more during the tax year. Second possibility is what? He must be in India for a period of 60 days or more during the tax year and 365 days or more during the 4 years preceding the tax year. If any condition is satisfied, he is regarded as resident. Both are satisfied, still resident. Both are not satisfied, he is regarded as non-resident. Makes sense, right? So let me simplify the concept to you here. So let's say, for example, tax year is 26-27. 4 years before that is what? 25-26, 24-25, 23-24, 22-23. So what are the possibilities here? First possibility is in this year he is greater or equal to 182 days. Second possibility is what? Greater or equal to 60 days during the tax year and 4 years preceding the tax year put together, he is there in India for greater or equal to 365 days. Then we will treat him as resident. So in order to treat an individual as resident, he must satisfy any one of the basic condition. And we have two basic conditions given by section 6.2. First one is what? He must be in India for a period of 182 days or more during the tax year. Or second possibility is what? He must be in India for a period of how many days, my dear friends? 60 days or more during the tax year and 365 days or more during the 4 years preceding the tax year. If any condition is satisfied, he is treated as resident. Both conditions satisfied, again is treated as resident. Both conditions are gone, he is treated as non-resident. Are we getting clarity, everybody? All of us? Very good. Come on, let's see next. Let me take an example with numbers. Let's say one person, Mr. X, he is in India for 80 days every year. Since last 5 years. And my question is he resident or non-resident? Come on, my friends, definitely my answer will be he will be a non-resident. The reason for that is what? 182 condition is not satisfied. 60 is satisfied, but 80 into last 4 years. 80 into last 4 years, if I see how many days it comes is 320 days. So 60 is satisfied, but 365 days is not satisfied. So you will be regarded as what, my dear friends? Non-resident, because to become resident, you must satisfy any one of the basic condition. That is, he must be in India for a period of 182 days or more during the tax year, or he must be in India for a period of 60 days or more during the tax year and 365 days or more during the 4 years preceding the tax year. I am sure we got very good clarity on this point. Everybody, sir, make sense? Excellent. So satisfy any one condition, you will become resident. Both conditions gone, you will become non-resident. When do you call him as ordinarily resident? We will talk about it separately. Don't worry. We will talk about it separately. Don't worry. But listen. I will discuss some special cases. First one. In case of an Indian citizen leaving India, he is going out of India for the purpose of employment outside India. If he is an Indian citizen who is leaving India for the purpose of employment outside India, what they told in the law is only first condition will apply. That means what? That second condition called 60 and 365 does not apply. Only first condition will apply means what? 182 days or more. So if a person is an Indian citizen who is leaving India for the purpose of employment outside India, then this kind of person is treated as a resident only if he is in India for a period of 182 days or more during the tax year. If not, he will be regarded as non-resident. Second point. In case of an Indian citizen leaving India as a member of crew, as a member of what, sir? Crew of an Indian ship. Crew means what? People who are working on the ship are regarded as crew, my dear friends. So in case of Indian citizen leaving India as a member of crew of an Indian ship, here also only first condition will apply. That means what? He must be in India for a period of 182 days or more during the tax year. Then only we'll treat him as resident. So in these two special cases, we will not apply that condition called 60 and 365. So what are two special cases I wrote here? First special case is what? In case of an Indian citizen, in case of what? Indian citizen leaving India for the purpose of employment outside India. Second point is what? In case of an Indian citizen leaving India as a member of crew of an Indian ship. Yes. So there are two special cases where first condition only will apply but not the second condition. That means what? Let me repeat, my dear students, once again for more clarity. Generally there are two conditions. If any of these condition is satisfied, I repeat, generally there are two conditions. If any of the condition is satisfied, we will treat them as a resident. Both are satisfied, still resident. Both are not satisfied, we will treat them as non-resident. And what are the two conditions? First one, he must be in India for a period of 182 days or more during the tax year. Second possibility is what? He must be in India for a period of 60 days or more during the tax year and 365 days or more during the 4 years preceding the tax year. So if any of this condition is satisfied, we will treat them as resident. But we discussed two special cases now. In these two special cases, we will apply only first condition. That means if first condition is satisfied, we will treat as a resident, if not gone. What are two special cases we discussed just now? First one, Indian citizen leaving India for the purpose of employment outside India. Second one, Indian citizen leaving India as a member of crew of an Indian ship. Crew means what? Working on the ship. Third special point. In case of an Indian citizen or a person of Indian origin coming to India for a visit during tax year. Indian citizen or a person of Indian origin coming to India for a visit during tax year. Here also only first condition will apply. So in simple terms, my dear friends, in these three special cases, we are not going to apply the second basic condition. We will apply only first basic condition. If first basic condition is satisfied, then person is resident. If first basic condition is gone, then the person is non-resident. And what are the first basic condition? He must be in India for a period of 182 days or more during the tax year. And what are three special cases, my dear friends? Come on. First one, Indian citizen leaving India for the purpose of employment outside India. Second case, Indian citizen leaving India as a member of crew of an Indian ship. Third case, Indian citizen or a person of Indian origin coming to India for a visit during the tax year. So in first two cases, person is going. First case going for employment, second case going as member of crew, third case coming to India for a visit during the tax year. But the three cases, one common point is, in all the 3 points, you have the word called Indian citizen. And the question only will tell you whether a person is Indian citizen or not. If in the exam, the question or practice, whatever we are going to do in the lectures, if the question is silent, don't assume the person is an Indian citizen. Question must specifically tell you that he is an Indian citizen. So what the first case? Indian citizen leaving India for the purpose of what? Employment outside India. Second case, Indian citizen leaving India as member of crew of an Indian ship. Third case, Indian citizen or a person of Indian origin coming to India for a visit during the tax year. But the word used is third case, special point we have. Indian citizen or a person of Indian origin. Now who is this gentleman? Person of Indian origin. Person of Indian origin means if he himself or any of his parents, he himself, my dear friends, or any of his parents or any of his grandparents were born in undivided India. What is the word used, sir? If he himself or any of his parents or any of his grandparents were born in undivided India, so that person himself or either his mother or father or any of his grandparents were born where? Undivided India. Undivided India means before independence, before 1947. Then the person is called person of Indian origin. Understanding, friends? So let me tell you, in my case, I am not born in undivided India. My father also is not born in undivided India, but my grandfather was born in undivided India. So my grandfather is regarded as what? Person of Indian origin. Are we getting clarity? So when do we treat a person as person of Indian origin? Whether he himself or any of his parents or any of his grandparents were born in undivided India, then we'll treat the person as person of Indian origin. So coming back, my dear friends, we'll simplify the concept once again now. There are two basic conditions which are given in section 6.2, and if any one is satisfied, we'll treat the person as a resident. Friends, correct or not? Next. In three special cases, only first basic condition will apply. Come on, friends, what is the line I wrote? In three special cases, only first basic condition will apply. What are three special cases? Come on, repeat again. What are the special cases? Number one, Indian citizen leaving India for the purpose of employment outside India. Indian citizen leaving India as member of crew of an Indian ship. The third point is Indian citizen or a person of Indian origin coming to India for a visit during the tax year. So in any of these three cases, my dear friends, only first basic condition will apply. We are not going to look at second basic condition. And what is that first basic condition? 182 days or more during the previous year. Very clear-cut point. Make sense, guys? Everyone? Good. Now let me tell you one more interesting special point, sir. That is, in case of Indian citizen or a person of Indian origin coming to India for a visit during the tax year. In case of Indian citizen, one more time I repeat, in case of Indian citizen or a person of Indian origin coming to India during the tax year. Here we have one more special point. that is total income other than foreign sources. Come on, what is the line? Total income other than foreign sources is greater than 15 lakhs. Total income other than foreign sources does not exceed 15 lakhs. If total income other than foreign source does not exceed 15 lakhs, my dear friends, we will apply only first basic condition. And what is that first basic condition? 182 days or more during the tax year. Next, if total income other than foreign sources is more than 15 lakhs, then we will apply first basic condition or greater or equal to 182 days or second basic condition where 60 days is replaced by 120 days. That means what? Greater than or equal to 120 days during the tax year and greater or equal to 365 days during 4 years preceding the tax year. Friends, clarity is very much required here. Please don't get yourself confused. Please get very much convinced. I will solve lot of questions. Don't worry. During the lecture, we'll discuss so many questions also. Don't worry at all. So friends, what are the points here? First one. In general, in order to treat the person as a resident, there are two basic conditions to be satisfied. And if any one is satisfied, we will treat him as a resident. Both are satisfied, still resident only. Both are not satisfied, we will treat the person as non-resident. And what are basic conditions? He must be in India for a period of 182 days or more during the tax year. And the second basic condition is what? He must be in India for a period of 60 days or more during the tax year and 365 days or more during the 4 years preceding the tax year. And in three special cases, we don't apply second basic condition, but we apply only first basic condition. That is, Indian citizen leaving India for the purpose of employment outside India. Second, Indian citizen leaving India as a member of crew of Indian ship. Third one, Indian citizen leaving, not leaving, third point is coming, no. Indian citizen or a person of Indian origin coming to India for a visit during the tax year. And in third case, we have one more special point. That is, third case, we will also look at whether a total income other than foreign sources is more than 15 lakhs or does not exceed 15 lakhs. If it is does not exceed 15 lakhs, we will apply only first condition. But if it is more than 15 lakhs, we have first condition also, but second second condition also with a small change. Second condition is 60 and 365. Instead of 60 and 365, we will apply 120 and 365. Understanding? Now listen. For calculation of number of days in India, part of the day is treated as full day. Next point, very important point, day of living and day of coming. Is always included. Come on friends, what is the line? Date of living. What is that line? Come on. Day of living outside India and the day of coming to India. Both are always included. There's no second thought about it. There's no doubt about it. Understanding, guys? So the day of living and day of coming, both are always included. Yes, my dear friends. Now listen. Let's take a wonderful example to get complete clarity on this concept, what I just explained to you. Listen. So let us say, for example, there is one person, Mr. X, who is an Indian citizen. And what has happened is, this person, he left India on 10th November 2026 for the purpose of employment outside India. Come on, friends. He left for what purpose, my dear friends? He left India for the purpose of employment outside India. And my question is very clear. Determine residential status of Mr. X for tax year 26-27. That is the question. Come on, my dear friends. How are we going to solve this? That is, generally, if an individual satisfies any one of the basic condition, if he satisfies any one of the basic condition given under section 6.2, he shall be regarded as resident. He shall be regarded as what, my dear friends? Resident. So if he satisfies any one of the basic condition under section 6.2, my dear friends, he shall be regarded as resident. However, now I'll write. However, in case of an individual leaving India, in case of an individual, come on friends, what is that line? In case of an individual leaving India for the purpose of employment outside India, the first basic condition, to be satisfied in order to treat as resident. So in order to treat as a resident, what should happen, my dear friends? First basic condition should be satisfied. Very clear cut point, my dear friends. So in order to treat as a resident, which condition should be satisfied? Come on, please tell me. In order to treat as a resident, the first basic condition should be satisfied. Very, very interesting and clear point. Now, what is the first basic condition? We all know that he must be in India for a period of 182 days or more during the previous year. During that, what is the first basic condition? He must be in India for a period of 182 days or more during the tax year. Now tell me, what is the tax year? The tax year is 26-27. In that period, he is in India from 1st April 2026 to 10th November 2026. Because that day he left outside India. And I already told you that day of coming and day of living, both are always included. Day of coming and day of living is always included. So he's in India from 1st April 2026 to 10 November 2026. So that means what? April he is there for 30 days, May 31 days, June 30 days, July 31, August 31, September 30, October 31, November 10 days. So totally is there for 30 plus 31 plus 30 plus 31 plus 31 plus 30 plus 31 plus 10. So technically is therefore 224 days. So when is therefore 224 days, my dear friends, what is your answer? First basic condition can be satisfied and Mr. X and what, sir? Mr. X shall be regarded as resident. First basic condition can be satisfied and Mr. X can be regarded as resident. That is an interesting point, my dear friends. Very, very important point which makes sense. So friends, normally there are two basic conditions, but in three special cases we apply only first basic condition. What are three special cases? Number one, Indian citizen leaving India for the purpose of employment outside India. Second, Indian citizen leaving India as member of crew of an Indian ship. Third special case, Indian citizen or a person of Indian origin who is coming to India for a visit during the tax year. And in third special case, one more point to be noted is that we will check whether total income is not more than 15 lakhs or more than 15 lakhs. If it is not more than 15 lakhs, only first basic condition. If it is more than 15 lakhs, then we have first basic condition or second basic condition also with a small change. That small change is 60 days has become 120 days. So that is the interesting concept to be noted. Makes sense, guys? Everybody please reply. A very, very, very interesting and wonderful concept, no doubt about it. Now listen. Now I'll tell one special point and one important note. Now I'll tell one special point and one important note, my dear friends. That is, in case of crew, in case of what, sir? Crew. What they told is, this crew member at the time of joining the ship, they get one certificate which is known as continuous discharge certificate. That's what we call it practically. Continuous discharge certificate is what they get at the time of joining the ship. Now what is the problem here is, let us say there is one person, Mr. Akash. This person Akash has entered the ship. And the ship is slowly crossing India border and slowly crossing territorial waters. Now assume for a second, it took 1-2 days to cross territorial waters. That means that 2 days in territorial waters, technically that 2 days ship is in territorial waters and technically that 2 days the person is in India only. But it is practically very difficult to track exactly that when ship has crossed territorial waters. How do you track it? That's where law told, don't worry, we'll make your job simple and easy. What they told is, in case of crew, for determination of residential status, for determination of what, sir? Residential status, the date of joining, the date of joining the ship, the date of joining the ship, till the date of signing off. Signing off means what? Leaving the ship. Date of joining till the date of signing off shall be excluded, shall be what, sir? Excluded for calculation of number of days in India. So for calculating number of days in India, the date of joining till the date of signing off shall be excluded for calculation of number of days in India. So for example, sir, let us say one person, Mr. A, he is an Indian citizen. He joined the ship as a crew member. He joined the ship as crew member and date of joining is equal to 10th August 2026 and date of signing off is equal to 25th December 2026. That means what? This period, whatever figure you get, this period will be excluded. This period will be excluded for calculation of number of days in India. So for calculation of number of days in India, this period is what, my dear friends? Excluded. So what is the period excluded now? So for tax year 26-27, when we are trying to determine residential status, what is excluded now? 10th August to 25th December. 10th August 26 to 25th December 26 is excluded, my dear friends, which is equal to August how many days? 10th also we have to include. 10 means 22 days in August plus September 30, October 31, November 30, December 25. 22 plus 30 plus 31 plus 30 plus 25, which is coming to 138 days. Understood? Now, total number of days in India is equal to 365 days minus 138 days. That is how we have to calculate. In case of crew member, there is a different way of calculation which goes like this, my dear friends, which is 227 days. So automatically he will become a resident because he is in India for 182 days or more during the tax year. I strongly believe that we are getting very good clarity on this concept, especially after discussing the example. Starting you might have some confusion, I also totally understand that, but after discussing the example, tremendous clarity should have come, no doubt about it. Clear, my dear students? Come on, look at our material. Residential status of individual 6.2. We have three categories: ROR, RNOR, NR. And for firms, AOPs, BOIs, companies, there are only two categories: resident and non-resident. So only individual and HUF can be resident but not ordinarily resident. When do you call ordinarily resident? We'll talk separately. For that we have some additional conditions. So moving forward, basic condition. Which section, friends? Section 6.2. An individual is said to be resident in India in any tax year if they satisfy at least one of the following condition. Number 1. He is present in India for a period of 182 days or more during the tax year, or present in India for 60 days or more in the tax year, and 365 days or more during the 4 years immediately preceding that tax year. And stay in India also includes stay in territorial waters, which is up to 12 nautical miles into the sea from the coastal line, including stay on a ship or a boat which is moored in those water. Moored means they are rotating in that waters. The period of stay need not be continuous. This is interesting. Period of stay need not always be continuous. He may be coming, going, coming, going, coming, going. And for counting the number of days in India, both the date of arrival and the date of departure are treated as days spent in India. A stay on a yacht is something like a houseboat, which is moored in territorial waters, is treated as presence in India because territorial waters is a part of India. If presence is for a part of the day and data is available, if it is not available, we will take full day. But if data is available, the count is made on hourly basis. Otherwise, both the day of entry and the day of exit are counted. And when do you call him as non-resident? If he does not satisfy any of the basic condition. Next part you see. Exception. In the following cases, 60 days limit in the second basic condition is extended to 182 days. That is 182 you have to satisfy to become a resident. First point, 6.3. Indian citizen who leaves India during the tax year for employment outside India or as a member of crew of an Indian ship. 6.4. Indian citizen or a person of Indian origin who being outside India, generally outside India, comes on a visit to India during the tax year. However, under section 6.5, with section 6.5, where such a visiting citizen or POI has total income other than foreign sources more than 15 lakhs. I told this to already. During the tax year, 60 days is read as 120 days, and such a person becomes resident if they are in India for 365 days or more in the preceding 4 years and 120 days or more in the tax year. Next line. Crew of a ship, eligible voyage, section 6.6, read with rules. For an Indian citizen who is a member of crew of a ship, the days on board during voyage are excluded. This is what I clearly told you. I give an example also. When counting the period of stay in India, excluded period is commencing from the date entered in the CDC. CDC means continuous discharge certificate for joining the ship and date of signing off. Eligible voyage means a voyage by a ship carrying passengers or freight in international traffic where the voyage either originates from an Indian port with a destination outside India or originates outside India with an Indian port as destination. So it is coming to India and going outside India. Are we getting clarity, everybody? So that's the story of concept of special cases in the basic condition, my dear friends. So friends, we have been discussing the concept of very clearly the basic conditions for determination of residential status in case of an individual, which is clearly given by section 6.2. Which section, my dear friends? 6.2. Now what does 6.2 say? That there are two basic conditions and any one you satisfy will treat you as a resident. Both are satisfied, still you are a resident. Nothing is satisfied, you are regarded as a non-resident. And what are both the basic condition? First one, he must be in India for a period of 182 days or more during the tax year. Or second possibility is what? He must be in India for a period of 60 days or more during the tax year and 365 days or more during the 4 years preceding the tax year. That's the story of the basic condition. But we have got some special points which are given by section 6.3 and also section 6.4. What is section 6.3? 6.3 talks about what? Indian citizen leaving India for the purpose of employment outside India. And it also covers Indian citizen leaving India as a member of crew of an Indian ship. In these two cases, my dear friends, we don't apply second basic condition. We apply only first basic condition. Next 6.4 talks about what? Indian citizen or a person of Indian origin who comes to India for a visit during the tax year. In these cases, what you need to satisfy is first basic condition only. And 6.5 talks about special case related to Indian citizen or person of Indian origin who is coming to India for a visit during previous year. What is the concept there? In case of an special case of Indian citizen or a person of Indian origin who is coming to India for a visit during previous year, what is special point? If total income other than foreign sources is more than 15 lakh rupees, then you have a second condition also possible, that is instead of 60 days, it is 120 days. That is, he must be in India for a period of 120 days or more during the tax year and 365 days or more during the 4 years preceding the tax year. So these are the interesting points what we discussed, my dear friends. And I am sure we got very good clarity till this stage. Clear? Good. Let me next talk about section 6.6 also we have done. That is about in case of a crew of an Indian ship. What we discussed is very clear that in case of crew of a ship, when he is entering into the ship or joining the ship, he is given one certificate known as continuous discharge certificate. and they clearly told in the law that date of joining till the date of signing off shall be excluded for calculation of number of days in India. That means that period he is treated as if he is not in India. That's an interesting point. Next point. Let me talk about something next, very interesting, section 6, 7, which deals with the concept of deemed resident. So name only says he is not a resident, he is a deemed resident. Now when do we treat a person as deemed resident? Please see that. An individual is treated as a deemed resident if all the following conditions are satisfied. I'll highlight that word, all the following conditions. So if all the following conditions are satisfied, he is treated as a deemed resident. He is not a resident, but he is deemed to be a resident. Number 1, Indian citizen. Number 2, total income other than income from foreign sources exceeds 15 lakh rupees during the tax year, similar to previous point what we just covered in 6.5. But that was about Indian citizen or a person of Indian origin who is coming to India for a visit during previous year. But what is this point? Deemed resident, Indian citizen, total income other than foreign sources more than 15 lakhs, and they are not liable to tax. And what, sir? They are not liable to tax in any other country by reason of domicile. Domicile means usually staying in that country, residence, or any other similar criteria. So for example, my dear friends, let's take a situation like this. Let us say there is one person, Mr. X. His total income in tax year is greater than 15 lakhs. And when I say total income, I am talking about total income other than foreign sources. Total income in tax year is more than 15 lakhs, and total income means other than foreign sources is greater than 15 lakhs. I am talking about a person named as Mr. X. Now, what is happening here is he does not satisfy any basic condition under section 6.2. But he is an Indian citizen and he is not liable to pay tax. He is not liable to pay tax in any other country. He is not liable to pay tax in any other country. In that case, law is telling we will treat this person, Mr. X, as a deemed resident. What do we call it, my dear friends? Deemed resident. So name only says deemed resident. That means he is not a resident of India, but he is deemed to be a resident of India. So what government is trying to tell is that, my dear friend, let us say you are in a country like Dubai, but you are an Indian citizen and your total income other than foreign source in India is more than 15 lakh rupees, and you are not liable to pay tax in Dubai, maybe because Dubai has given exemption. In that case, we will treat as if you are deemed to be resident in India. So government is telling, Indian government is telling, if you are not liable to tax in any country, we will tax you in India. If you are not liable to pay tax, I repeat one more time, if you are not liable to pay tax in any other country, we will tax you in India. Provided you are an Indian citizen and provided your total income other than foreign source is more than 15 lakh rupees, then only will trouble you. If not, we will not touch you. Clear, friends? So deemed resident concept will come only when all the following conditions are satisfied. Number 1, the person is an Indian citizen. Number 2, his total income other than foreign source is more than 15 lakh rupees. Number 3, he is not liable to pay tax in any other country by reason of residence, domicile, or any other reason, whatever it is. That's the story of deemed resident. Very interesting, very important. Clear, friends? Excellent. Now listen. Listen very clearly now. If a person is a resident, if a person is what, sir? Resident, then he may be ROR or RNOR. So if he is a resident, he will be further classified into resident and ordinarily resident, resident but not ordinarily resident, and ROR and RNOR is based on additional conditions. Is based on what, my dear friends? Additional conditions which are given under section 613. 613 has given some additional conditions. 2 conditions they have given. Clear, friends? Everybody. And there are 2 additional conditions. An individual will be regarded as ROR only if both additional conditions are satisfied. Only if both additional conditions are satisfied. Are we getting clarity, my dear friends? What is that line I just wrote? An individual will be regarded as ROR, that is resident and ordinarily resident, only if both additional conditions are satisfied. So if both the additional conditions are satisfied, we will treat him as ROR. Now let me simplify the concept for you. Listen very clearly here. Sir, let us say there are basic conditions, there are additional conditions, and let me write status. Basic 1 satisfied, additional 1 satisfied. We will treat them as RNOR. Basic 1 satisfied, additional 2 satisfied. We will treat them as ROR. Basic both satisfied, additional 1 satisfied. Again the answer is RNOR. Basic 2, additional 0. Again the answer is RNOR. Basic 0, additional 1. The answer is NR. Basic 0, additional 2, the answer is NR. So once basic condition is only gone, the person will be treated as non-resident. Once basic condition is gone, the person will be treated as what, my dear friends? Non-resident. So the story of resident will come into picture only when basic condition is satisfied. Understanding, my dear friends? Only when the basic condition is satisfied, then only the word called resident will come into picture. And if the person is resident, we look at something called additional conditions. Now listen. In case of section 6.5 and 6.7. 6.5 and 6.7. What is 6.5? Indian citizen or a person of Indian origin coming to India for a visit during tax year, and total income other than foreign source is greater than 15 lakhs. And 6.7 talks about deemed resident. Deemed resident. So here, Indian citizen, person of Indian origin, coming to India for a visit during tax year and total income is more than 15 lakhs and satisfying 120 days and 365 days condition. Satisfying what, sir? 120 days and 365 days condition. So this case, 6.5 case and also 6.7 case. Individual shall be regarded as RNOR only. shall be regarded as what, my dear friends? RNOR only, even if additional conditions are satisfied. So even though additional conditions are satisfied, my dear friends, still we will treat the person as RNOR. So even if additional conditions are satisfied, still the person will be treated as RNOR only, my dear friends. No second thought about it. So a deemed resident as well as an Indian citizen or person of Indian origin coming to India for a visit during tax year and total income is more than 15 lakhs. These two cases, my dear friends, the person will be treated as RNOR only, even if both additional conditions are satisfied. I am sure we are getting clarity. And by the way, what are the additional conditions? Additional conditions, as I told you, are given by section 613. Come on. What are the additional conditions that are required to be satisfied? And I told you that only when both are satisfied, we'll treat the person as ROR. Additional conditions which are given by section 613, my dear friends, there are two additional conditions. When both are satisfied, we'll treat the person as ROR. If not, we'll treat the person as RNOR. How many additional conditions are there? Two additional conditions are there. Number one, he must be resident in India in at least 2 out of 10 tax years preceding the tax year. So prior to tax year, 10 years prior to tax years, in that 10 years, at least 2 years, he is a resident. And how he will be resident? Already we know the answer. He will be a resident by satisfying any one of the basic condition. Straight answer. How will that person become a resident? By satisfying any one of the basic condition. Second, he must be in India for a period of 730 days or more during 7 years preceding the tax year. That means what you are trying to say is something like this. Listen very clearly, my dear friends. Let us say, for example, just for example, tax year is 26-27. 10 years before that is what? 25-26, 24-25, 23-24, 22-23, 21-22, 20-21, 19-20, 18-19, 17-18, 16-17. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 years. Now what is the point here is that in these 10 years, he must be a resident in at least 2 out of 10. And how will be resident? Obviously, he will be resident by satisfying any one of the basic condition. He must be resident in at least 2 out of 10 years preceding the tax year. And in last 7 years, he must be in India for greater or equal to 730 days. So when both additional conditions are satisfied, then only we treat the person as ROR. But if any additional condition is gone, we will treat the person as what, my dear friends? RNOR. Getting the clarity, my dear friends? So a person will be regarded as, other words, an individual will be regarded as resident and ordinarily resident only and only when both the additional conditions are satisfied. When both additional conditions are satisfied, then only we treat the person as ROR, resident and ordinarily resident. So to treat the person as ROR, both additional conditions must be satisfied. There is no second thought about it. Makes sense, guys, everybody? So both additional conditions should be satisfied to treat the person as ROR. Are we all clear? Everybody come on, please reply. Good, fair enough. Now listen next. Let us say, for example, there is one person, Mr. X. he is in India for 100 days every year since last 10 years. Determine residential status. Come on, relax. Before you start doing it, first and foremost important question. In the question, did they say he is an Indian citizen? Answer is no. And unless the question says he is an Indian citizen, I already told you this point very clearly that unless the question says he is an Indian citizen, don't assume that person is an Indian citizen. Question must specifically tell you that he is an Indian citizen. If not, don't assume that he is an Indian citizen. And if he is not an Indian citizen, and if he is not a person of Indian origin, that special case of 63, 64, 65 will not come into picture. Understanding everybody? Because 63 talks about Indian citizen for employment, Indian citizen, crew of ship. 64 talks about Indian citizen or a person of Indian origin. 65 talks about special case of more than 15 lakhs. So it's a very clear-cut point, my dear friends. So once it is not an Indian citizen, what will happen? Both basic conditions are available. Look at it now. In tax year, he is there for 100 days. So, Mr. X can satisfy second basic condition. Now, please tell me, how did X satisfy second basic condition? Because second basic condition says 60 days or more during the tax year and 365 days or more during the 4 years preceding the tax year. And 4 years preceding the tax year, he is there for 400 days. 4 years preceding the tax year, he is there for 400 days. How do I know 400 days is very clear? 100 days every year, 400 days. And what is second basic condition? 60 days or more during the tax year and 365 days or more during the 4 years preceding the tax year. So can he satisfy second basic condition? Yes. And once he satisfies second basic condition, we will treat him as resident. Correct, no friends? Further, in last 7 years, prior to tax year, he is in India for 700 days. In last 7 years, prior to tax year, he is in India for 700 days. Accordingly, additional conditions not satisfied. Student is asking, sir, what is the additional condition we are looking at? In last 7 years, he must be in India for a period of 730 days or more. But how many days is there? Only 700 days. So can he satisfy second additional condition? Answer is no. Student is asking, sir, why don't you look at the first additional condition also? That is a resident in at least 2 out of 10 years. What should I do? What should I do by looking at first additional condition? Because, my dear friends, you apply the logic. Once a second additional condition failed, what is second additional condition? 730 days or more in last 7 years. Once a second additional condition failed, there is no requirement to look at first additional condition. Come on, what did I just say? I told a wonderful statement. Once a second additional condition failed, I repeat, once a second additional condition failed, there is no requirement to look at first additional condition. The logic behind that is what? The logic behind that is very clear that once second additional condition is gone, first one, whether you satisfy or you don't satisfy, doesn't make a difference. Because individual will become resident and ordinarily resident only when both additional conditions are satisfied. If both are not satisfied, or one also not satisfied, still the person will be RNOR only. So to become ROR, individual must satisfy both additional conditions. Even if one or none are satisfied, still he will be regarded as RNOR. A very, very interesting point. Accordingly, additional conditions are not satisfied. Hence, the residential status of Mr. X shall be resident but not ordinarily resident. Resident but not ordinarily resident. So that's the story of this very, very interesting concept which clearly talks about the provisions of what, my dear friends? Come on. Residential status of an individual. Come on, get back. A deemed resident under 6.7 is always classified as RNOR. 6.8. 6.7 does not apply to individual who is already a resident under normal test in subsection 2 to subsection 6. If he is already a resident, then why will you apply the concept of deemed resident? Liable to tax means income tax liability exists on the person under the law of that country. In the law, as per law of that country, income tax liability is there. It also covers person subsequently exempted from such liability. Subsequent exemption is not the criteria, whether it is liable or not is the criteria. And person of Indian origin means a person is of Indian origin if they or either of their parents or any of their grandparents, and grandparents cover both maternal and paternal. Maternal means mother's side, paternal means father's side, was born in undivided India. Very, very interesting point. Next point. As per section 6.14, income from foreign sources means income which accrues or is outside India, except income derived from business controlled in or profession set up in India, and which is not deemed to occur as in India. So income from foreign source excludes what? Income derived from business controlled from India or profession set up in India. That is excluded from foreign sources means that will be included for calculation of 15 lakhs. So let's say for example something like this. There is one person, Mr. X. He is an Indian citizen. Comes to India for visit during previous year. For a visit during the tax year. Please edit that. For a visit during the tax year. In tax year, he is there for 150 days. And 4 years prior to tax year, he is there for 400 days. And his income is like this. Income from house property is, let us say, 5 lakhs. Income from other sources, 6 lakhs. Income from business outside India. Income from what, friends? Business outside India. Income from, what is that line? Come on. Income from business outside India, but controlled from India. Business is outside India, but controlled from India. And this figure is, let us say, 7 lakh rupees. And total figure is 18 lakhs. Now tell me, what will be the total income? Wait a second. Let me add some more thing here so that complete clarity will come. So income from house property is 5 lakh rupees. Income from other source is 6 lakhs. Income from business outside India but controlled from India is 7 lakhs. And there is also income from business outside India and controlled from outside India. I am sure the third point, fourth point, we got the difference, my dear friends. The third point, what I told, income from business outside India but controlled from India. Fourth point, what I told is income from business outside India and controlled also from, wait a second, this small change I'll do. Controlled from and controlled also from outside India. This figure I'll take it as 5 lakh rupees. Total figure 5 plus 6, 11, 11 plus 7, 18, 18 plus 5, 23 lakhs. So 23 lakhs is the total income. And what am I supposed to do to check that working? I am supposed to look at something called total income other than foreign sources. This is my criteria to decide. My criteria to decide is what? Total income other than foreign sources. If that is more than 15 lakh rupees, then the special case of 120 days and 365 days will come into picture. If total income other than foreign sources. And income from foreign sources means income which accrues or arises outside India and which is not deemed to arise in India. But income from foreign source excludes what? They clearly wrote the word except, what is that word? Except income from business controlled in or profession set up in India. So foreign sources does not cover income from business which is controlled from India. That means what? Total income other than foreign sources will be 5 lakhs plus 6 lakhs plus 7 lakhs. Total will be 18 lakhs. Once it is 18 lakhs, then Mr. X will definitely be regarded as a resident. So while calculating that 15 lakhs figure, my dear friends, you have to be very, very careful because total income other than foreign sources should be more than 15 lakhs. And when I say foreign sources means income which accrues outside India and which is not deemed to arise in India except income from a business controlled in or profession set up in India. Very, very interesting concept. And I'm pretty confident and sure after this we got some good clarity. See here. An individual is ROR if they satisfy both additional conditions as I told. Number 1, resident in at least 2 out of 10 tax years immediately preceding the relevant tax year. He is in India for 730 days or more during the 7 years immediately preceding the relevant tax year. And statutorily, 613 says what? A person is regarded as RNOR, that means reverse answer now. If he has been a non-resident in 9 out of 10 or in India for 729 days or less in 7 tax years, or a citizen or a person of Indian origin with income excluding foreign source above 15 lakhs who is in India for 120 days or more but less than 182 days in the tax year. And deemed resident. I told you already that deemed resident is always an RNOR. So summary. Basic, anyone satisfied is a resident. Additional, not relevant. RNOR, anyone, both. ROR, we have to satisfy both additional conditions. RNOR, basic, anyone. Additional, any one or none. Non-resident, none satisfied. Additional is not relevant at all. Speak out, my dear friends. That's the story of residential status of an individual. Very, very interesting concept and I'm pretty confident and sure it makes a lot of sense for all of us. So listen here. ROR, RNOR, NR. ROR, basic, plus both additional. Basic condition is satisfied, both additional also satisfied. RNOR, 3 cases will be there. Case number 1, basic satisfied. Basic means what? Basic condition is satisfied, but additional conditions not satisfied. Second one, deemed resident under section 6.7. Deemed resident under section 6.7. Deemed resident is always an RNOR, guys. Next. Person becoming resident as per section 6.5. Deemed resident is 6.7. Who is that person becoming resident as per 6.5? Indian citizen or a person of Indian origin who comes to India for a visit during the tax year and total income is more than 15 lakhs and satisfies 120 days or more during the tax year and 365 days or more during the 4 years preceding the tax year. Non-resident, when do we call it? Basic condition not satisfied. That is the story, guys. This is a concept of residential status of an individual, but clarity of thought and perfection is very much required. Are we all clear? Done. Let's proceed. So friends, we have clearly understood the concept of residential status of an individual, wherein we have a classification between ROR, RNOR and NR. Now let me talk about HUF as well. In case of HUF, we have first initial categorization as a resident, other side non-resident. And this resident non-resident bifurcation is clearly based on the category known as control and management. Control and management. If control and management is wholly or partly in India, we'll treat it as resident. But if control and management is wholly outside India, we'll treat it as non-resident. And if resident, again we look at something known as additional conditions. And this additional conditions are given by section 13, that is same as individual. And this additional conditions, who has to satisfy? Karta must satisfy. Karta must satisfy the additional conditions. Rest all story is same. Come on, get back. HUF, section 6.9 and 6.13. 6.9 is for basic, 6.13 is additional, which is the same one. HUF is resident in India if control and management is wholly or partly in India. And it is non-resident if control and management is wholly outside India. And generally we talk about control and management, my dear friends. There is something called de jure control and de facto control. De jure control means, de jure control generally means who is supposed to control. I repeat one more time. De jure control generally means who is supposed to control. But de facto control means who actually controls. I repeat. De jure control means who is supposed to control, and de facto control means who actually controls. That is an interesting point to be noted. So who is supposed to control, that is known as de jure control. Who actually controls is known as de facto control. And income tax law says what is relevant for us is de facto control, because we are not bothered about who is supposed to control. We are more bothered about who is actually controlling. And if control and management is wholly or partly in India, it is regarded as resident. And if control and management is wholly outside India, it is treated as non-resident. And once a HUF is a resident, we will again look at something known as additional conditions, which are given by the same section, section 613. That same story of resident in at least 2 out of 10, 730 days or more in last 7 years, that same concept will come into picture. And if both additional conditions are satisfied, we'll treat the HUF as ROR. And if any additional condition is not satisfied or none are satisfied, we'll treat the HUF as RNOR. Same like individual, not much of change. So that's the story of additional conditions, which is same as an individual. Next point. Firms, AOP, BOI and other persons, 6.9 and 6.11. They have only two status, resident and non-resident. That's it. Resident, non-resident. That's it. If firm, AOP or BOI is a resident, if control and management is wholly or partly in India. It is non-resident if it is wholly outside India. That's it. There is nothing called ROR, RNOR. The concept of ROR, RNOR, I repeat, the concept of ROR, RNOR is only in case of individual and HUF. Other than individual and HUF, there is no concept of ROR and RNOR. The words known as ordinarily resident, not ordinary resident, is there only in case of individual and HUF. Next line. Important points. Control and management means central control and management and not the day-to-day running of business by servants, employees or agents. Business may be carried on outside India while its control and management is wholly within India. Business may be carried on where, sir? Outside India, while control and management is wholly in India. The place of control may differ from usual place of business and even from registered office. We are not bothered about where the registered office is. We are bothered only about where is the place of control. Control and management implies the functioning of the controlling and directing power, basically seating power, controlling and directing power at a particular place with some degree of permanence. Functioning of what? Controlling and directing power. So direction seat is there at a particular place with some degree of permanence. Where that is located, that is relevant for us. Next point. Residential status of company, which is dealt by section 610, my dear friends. And what does it talk about? A company is a resident if it is an Indian company or place of effective management in that year is in India. Generally for HUF, firms, LLPs, the words used is control and management, but for company we use the word place of effective management. And place of effective management is decided based on where directors are located, where assets are located. There are various parameters which are taken into consideration to decide this concept called place of effective management. Indian company is always a resident. Foreign company is a resident only if the place of effective management is in India. So that's the concept of residential status of company. So friends, that's the story of residential status for individual, HUF, firms, LLPs, AOPs, BOIs and companies. So for individual, generally we will decide based on 6.2 and 6.13. Special cases are also there. HUF is based on 6.9 and 6.13. Firm, LLP, it is 6.9 and 6.11. Companies is given by section 610. You can see that very clearly. Make sense, guys? So that is the story of residential status, but the topic is not done. We just understood when do we treat a person as a resident, but still lot of story is pending, my dear friends, which we need to talk in detail. Clear? Come on, concentrate now. Let me talk about some important discussion known as section 5, which deals with scope of total income. Scope of what, my dear friends? Total income, which says generally income is divided into Indian income and foreign income. Come on, friends, what is the line I wrote? Generally, income is divided into Indian income and foreign income. And what does Indian income mean? Indian income means income accrued or received or income accrued or received or deemed to be received or deemed to accrue or arise in India. Come on friends, when do we treat an income as Indian income? An income is an Indian income if income is accrued. If income is what? Accrued. Accrued means what? Generally income will accrue at a place where you have rendered the work. It's a right. The right will generate where you have done the work. For example, sir, let us say you have done work in India. You have done work in India, but payment is received in Dubai. Work is done in India, payment is received in Dubai. Even though payment is received in Dubai, since work is done in India, it is known as Indian income. It is known as what income? Indian income. But if work is done in US and income is received in India, still it is Indian income because received in India. Got it, my dear friends? So when do we call income as Indian income? Income accrued or received or deemed to be received or deemed to occur as in India. And these two concepts of deemed to be received, deemed to occur as in India, we will talk separately. And when do we call income as foreign income? An income is foreign income if income is accrued and received outside India. An income is known as foreign income if income is accrued and received, where, my dear friends, both are outside India. Accrued means work is done outside India. So for example, my dear friends, let us say work done in US and payment received in India. What do we call it, my dear friends? Definitely we call it as Indian income. Next situation. Work done in India and payment received in US. Still it is known as Indian income. Now why it is Indian income? Even though the payment is received in US, my dear friends, work is done where? It is in India. So if accrual is in India, or receipt is in India, it is still known as an Indian income. Last situation. Work done in US and payment also received in US. Work is done in US and payment also received in US, then we will call it as foreign income. Because income accrued and received both are outside India. Income accrued outside India and received also outside India. If any one is in India, if accrual or receipt, one of them is in India, we treat it as Indian income. But if both are outside India, we treat it as foreign income. Understanding, my dear friends? Everyone, sir. Now why this much effort we are taking? Some students might get that out. Sir, why are we taking this much effort to understand which income is Indian income, which income is foreign income? There is one strong reason for that, my dear friends. Listen very clearly. We know that there are three types of person called ROR, RNOR and NR. ROR means what? Resident and ordinarily resident. ROR is taxable on Indian income and foreign income. Technically, he is taxable on global income. So wherever you earn income, you are still required to pay tax in India. You might get one doubt. Sir, what if a person is in India, he has earned income in US, accrued in US, received in US, foreign income. And they might tell, in US also you pay tax. Will they pay tax in US and also in India, sir? For that there is something called double taxation relief. What relief? Double taxation relief, which we will talk separately. What is the double taxation relief which is there for you at final level? Not now. At final level, you have that concept called double taxation relief, how that relief will come. But in general, resident and ordinarily resident, ROR, is taxable on global income. That is, both Indian income as well as foreign income will be taxable. Next, other side. Non-resident is taxable only on Indian income. Non-resident is taxable only on what income, my dear friends? Indian income. RNOR, resident but not ordinarily resident. He is taxable on Indian income plus foreign income in two cases. Number one, business income which is controlled from India. Business income which is controlled from India. Number two, professional income which is set up in India. Business income which is controlled from India. Professional income which is set up in India. So set up in India means having an office in India. So if you observe carefully, my dear friends, other way round of writing this concept is, listen, if income is an Indian income, it is taxable for all. So whether you are RNOR, or whether you are ROR, or whether you are NR, still it will be taxable if income is an Indian income. So if income is Indian income, ROR, RNOR, NR, everybody is taxable if income is an Indian income. And when do we treat income as Indian income? Income is accrued or received or deemed to be received or deemed to accrue or arise in India. We treat it as Indian income. Indian income is taxable for all. If it is foreign income, the answer will be, it is taxable for ROR and RNOR also taxable in two cases. And what are the two cases? Business income which is controlled from India, professional income which is set up in India. I am sure we got very good clarity, my dear friends. Extremely important point. Tremendous clarity is required. So let's take some example. Two examples I'll give. Listen very clearly. Example 1. Let us say there is Shiva Teja, and what is happening is I've got a property in US and rent is received in US. Property also is in US, rent is received also in US. So that means what is happening here? Accrued in US, received also in US. When accrual, receipt both are in US, we will treat it as what income, my dear friends? Foreign income. If it is foreign income, is it taxable? So if it is foreign income, is it taxable? Directly don't tell taxable, not taxable. Directly don't jump to that conclusion, because we have to decide based on residential status. So with this, you have to understand very clearly that there are two important parameters to decide taxability. Parameter number 1, residential status. Parameter number 2, whether it is Indian income or foreign income. Both parameters we have to take into account to decide whether income is taxable or it is not taxable. What are the two parameters? Number 1, residential status. Number 2, accrual and receipt of income. Based on both the parameters together, we have to decide whether income is taxable or not taxable. Are we clear, everybody? Good. See now. Accrued in US, received in US. We treat it as foreign income. Now what will happen? If Shiva Teja is ROR, then definitely answer is taxable. Next. If Shiva Teja is NR, definitely answer is not taxable. And finally, last question, what will be your answer if Shiva Teja is RNOR? If an individual or if a person is RNOR, if it is foreign income, it is taxable only in two cases. Business income controlled from India, controlled wholly or partly from India for that matter. Business income which is controlled wholly or partly from India, profession set up in India. Now tell me, is this business income? No. Is this professional income? No. So my answer will be not taxable. Are we getting clarity? Excellent. One more example to get complete perfection on this. That is, Shiva Teja is a chartered accountant having an office in India. I have got a proper office set up in India. Now what I have done is, I went to US. And I provided service in US. And payment also received in US. Sir, I provided a service in US and payment is also received in US. I'm sure we got clarity on this point, everybody. Now please tell me, what kind of income is that? One service is in US, that means what? One service is in US, what is the answer, my dear friends? Accrued in US. And payment or receipt is also in US. Both are in US. So what kind of income we call it? Foreign income. Now the moment we came to a conclusion that it is foreign income, now the doubt will start coming whether it is taxable or not taxable. That will decide based on what? Residential status. So if Shiva Teja is ROR, without any second discussion, it is taxable. And if Shiva Teja is a non-resident, it is not taxable because it is foreign income. Because it is foreign income. So always keep in mind, non-resident is never taxable on foreign income. But if it is Indian income, we will tax for everybody, whatever is your residential status. So if Shiva Teja is non-resident, what is the answer? Not taxable. And if Shiva Teja is RNOR, answer is taxable this time. Last point I wrote not taxable, but this point I am telling taxable. The reason because this income is nothing but a professional income. Professional income, and I am having a setup in India. Professional income having a setup in India. So I clearly told you that foreign income is taxable for RNOR in two cases. Number one, business income which is controlled wholly or partly from India. Second, number two, professional income set up in India. That is the story of this very, very important concept of section 5, scope of total income. Extremely important. Lot of questions will solve on this. No doubt about it. Clear? Good. So friends, I am sure we got very good clarity on this concept of discussion about section 5, scope of total income, which divides income into two categories, Indian income and foreign income. Indian income means what? Income accrued or received or deemed to be received or deemed to occur as in India. And when do we call income as foreign income? Accrued and received both outside India. And if income is Indian income, it is taxable for ROR, RNOR and NR. And if income is foreign income, it is taxable for ROR always and taxable for RNOR also in two cases. What are the two cases? Business income controlled wholly or partly from India. Professional income which is set up in India. Come on, see now. Section 5. Scope of total income. Please see that. Scope of total income or tax incidence decides. Scope of total income or tax incidence decide who has to pay Indian income tax on income accrued or received in India or outside India. Two basic concepts. Number one is receipt. Received, where money actually reaches the assessee or their representative. Second word is what? Accrual. Income accrues or arises where the right to receive it vests in the assessee. Accrue means to arise as a natural growth or increase. Arise means to come into existence. So if anything is in India, accrual or receipt, anything is in India, we call it Indian income, and if both are not in India, we call it foreign income. Thus, tax incidence depends on three important parameters: residential status, accrual, receipts. If income is received or deemed to be received, we will tax for everybody. Accrued in India, taxable for everybody. Foreign income, business controlled in India or profession set up in India, we will tax for ROR, tax for RNOR, NR not taxable. Any other foreign source, we will tax only for ROR, RNOR, NR not taxable. Finally, last point, past untaxed profit brought to India. Past means what? Some old money, old income which is now brought to India. So for current year, so for tax year, it is not an income because it is some past untaxed profit which is brought to India now. It's some old money, old balance. So we will not tax it for anybody. So an important point is what? Only an individual HUF can be ROR and RNOR. ROR is taxable on global income. For such a person, receipt, remittance does not make any difference. And a non-resident is taxable only on Indian income, and a non-resident is not taxable on foreign income. So that's the story of section 5, scope of total income. We will go ahead and discuss some interesting sections and also solve some interesting questions as well, my dear friends. Come on. So friends, we have clearly discussed the concept of section 5, scope of total income, which specifies that income is classified into two types of income known as Indian income and foreign income. What is Indian income? Income which is accrued or received or deemed to be received or deemed to occur as in India. And what do you say as foreign income? Foreign income is that income which is accrued and received both outside India. So if accrued and received both are outside India, we treat the income as foreign income. And if anyone is in India, we treat it as Indian income. Now what is going to happen? If income is an Indian income, it is taxable for ROR, RNOR and NR. So whatever is the residential status, still it is taxable. And if income is foreign income, it is taxable for ROR and it is taxable for RNOR also in two cases. And what are the two cases? Business income, which is controlled wholly or partly from India. Professional income, which is set up in India. Set up in India means having an office in India. So what we'll do now is, before we proceed to next discussion about section 7, section 9, which talks about incomes deemed to be received in India, income deemed to occur in India, let's once solve some questions and become perfect. Before that, let's once again recall the residential status of individual. So friends, when do we treat an individual as resident? Generally, an individual is treated as a resident if he satisfies any one of the basic conditions given under section 6.2. How many basic conditions are there? There are two basic conditions. Number 1, he must be in India for a period of 182 days or more during the tax year, or he must be in India for a period of 60 days or more during the tax year and 365 days or more during the 4 years preceding the tax year. Then 6.3 talks about two special cases, that is Indian citizen leaving India for the purpose of employment outside India. Indian citizen leaving India as a member of crew of an Indian ship. In these two cases, we don't apply the provisions of second basic condition. We'll apply only first basic condition. That is, he must be in India for a period of 182 days or more during the previous year to be regarded as a resident. Then 6.4 talks about a special case known as Indian citizen or a person of Indian origin who is coming to India for a visit during the tax year. He is regarded as a resident only if the first basic condition is satisfied. Next, 6.5 talks about Indian citizen or a person of Indian origin who is coming to India for a visit during the tax year and his total income is more than 15 lakh rupees. In such case, he will be regarded as a resident if any one of the basic condition is satisfied, but the second condition is slightly modified. Second condition is instead of 60, it is 120 days. That is 120 days or more during the tax year and 365 days or more during the 4 years preceding the tax year. That's an interesting concept. Makes sense, right, everybody? So that's the story of 6.2, 6.3, 6.4 and 6.5. And apart from that, we have discussed something known as 6.13, where we clearly discuss the concept of additional conditions. Additional conditions, there are two conditions. Both the conditions are satisfied. We'll treat the person as what, my dear friends? Individual will be treated as resident and ordinarily resident. And if any one or none of the conditions are satisfied, he will be treated as resident but not ordinarily resident. And what are the additional conditions? He must be in India for a period of, first one is resident, so that I'll tell first. He must be resident in India in at least 2 out of 10 years preceding the tax year. Second one, he must be in India for a period of 730 days or more during the 7 years preceding the tax year. So if both the conditions are satisfied, we'll treat the person as a resident and ordinarily resident. And if any condition failed, we'll treat him as what, my dear friends? Come on. If any condition failed, we'll treat him as resident but not ordinarily resident. And if basic condition is only gone, we'll treat the person as non-resident. So that's the synopsis and a recall of concept what we have discussed. Apart from this, we have also discussed the special concept of deemed resident. I hope you guys remember that concept of deemed resident. Who is deemed resident, my dear friends? He is not a resident, but he is deemed to be a resident in India. A very important concept dealt by section 6, 7. And when do we treat a person as deemed resident? A person is treated as a deemed resident only when the following conditions are satisfied. And what are those conditions? Number 1, he must be an Indian citizen. Number 2, his total income other than income from foreign sources is more than 15 lakh rupees. And the last condition, he is not liable to pay tax in any other country by reason of domicile, residence or any other similar criteria. If all these conditions are satisfied, he will be regarded as a deemed resident. Important concept, guys. Deemed resident concept is dealt by which section? Section 6, 7. Clear, everybody? Very good. This part is done. 6.13 we have discussed. And for HUF, what is the concept? But if I want HUF, let's revise. HUF, what is the story? HUF is regarded as resident only if the control and management is wholly or partly in India. If control and management is wholly outside India, it is stated as a non-resident. That concept also we have covered. Make sense, right, everybody? Very good. And once HUF is a resident, to decide whether it is a resident and ordinarily resident or resident but not ordinarily resident, we look at something known as additional conditions. And additional conditions for HUF is same as individual. But in case of HUF, who must satisfy the additional conditions is Karta must satisfy the additional conditions. Next point. For firm, AOP, BO and other persons, what is the concept? If control and management is wholly or partly in India, it is regarded as resident. And if control and management is wholly outside India, it is treated as non-resident. And the last but not the least, in case of company, what is the answer? In case of company, if it is an Indian company, if it is what company? Indian company. Indian company is always regarded as a resident. Indian company is always regarded as resident. And foreign company is regarded as resident only if POEM is wholly in India. And POEM stands for Place of Effective Management. Generally for HUF, firm, AOP, we are looking at the word known as control and management. But in case of foreign company, the language used is POEM, which stands for Place of Effective Management. So this is a quick revision of all the concepts what we have discussed. Shall we proceed, my dear friends? Come on. Next point. Let me talk about section 7, which deals with the concept of income deemed to be received in India. This concept is interesting for a simple reason, my dear friends. We have discussed the point that an income is regarded as Indian income in following case. If it is accrued or received or deemed to be received or deemed to accrue or arise in India. So if income is accrued or received or deemed to be received or deemed to accrue or arise in India, it is regarded as an Indian income. That is the point what we clearly discussed. Come on, see now. What is the meaning of this word called income deemed to be received in India? Following incomes are deemed to be received in India in the tax year even without actual receipt. Number 1, employer's contribution to recognized provident fund in excess of 12% of salary. Friends, Let me explain some concept to you here. Please listen. There is something called RPF, URPF, PPF. RPF stands for Recognized Provident Fund. Come on, what does RPF stands for? RPF stands for Recognized Provident Fund, and that is recognized by Commissioner. URPF is what? Unrecognized Provident Fund. And PPF stands for what? PPF stands for Public Provident Fund. See, normally in case of employer-employee, the contribution is made to either RPF or URPF. Public Provident Fund, anybody can contribute, even self-employed person. What they told in the law is, employer contribution. When there is an employer contribution, what they told in RPF is that employer contribution in excess of 12% of salary is taxable. But in case of URPF, not taxable, because in case of unrecognized provident fund, it is not taxable now, but taxability will come into picture at the time of withdrawal. At the time of withdrawal, definitely taxability will come into picture. See next. PPF, I'll write it as not applicable. Obviously not applicable for a simple reason, because there is no concept of employer contribution in case of public provident fund. Next. Employee contribution. First of all, what is provident fund? Provident fund is like a saving scheme. Provident fund is like a saving scheme where money is being saved on which you get interest. Employee contribution, in case of RPF, law told you can claim deduction under section 123. You can claim what, my dear friends? Deduction under section 123. URPF, no deduction. URPF, yearly nothing will happen. But at the end, when you withdraw, tremendous tax will come. PPF, same concept again. Deduction will come under section 123. Next, interest. In case of RPF, what they told in the law is, in excess of 9.5% per annum is taxable. But generally we don't get 9.5% also. Don't worry. URPF, it is not taxable. PPF also not taxable because it is covered in exemption. Finally, withdrawal. What they told in RPF is, my dear friends, not taxable if service is for more than 5 years. So if service is rendered for more than 5 years, my dear friends, whatever amount you withdraw at the time of retirement or maturity, whatever it is not taxable. URPF, definitely it is taxable. PPF, it is not taxable. But now comes the question, in URPF, how do we tax this? In URPF, how do we tax this? So when you are withdrawing, there are 4 important components. That is, employee contribution, that is his own contribution. Interest on employee contribution. Next, employer contribution. Last one, interest on employer contribution. Understanding, my dear friends? So there are four components what we get at the time of withdrawal. One is employee's own contribution. Second, interest on employee contribution. Next one, employer contribution. And the last one is interest on employer contribution. Now what they told in the law is, we are talking about something called URPF tax treatment at the time of withdrawal. And let me write one point here itself. That is, same tax treatment will apply. Same tax treatment will apply for RPF also. If service is less than 5 years. And what they told in the law is like this. Employee contribution, it is not taxable because it is our own money which is coming back to us. Interest on employee contribution, they told in the law, we will tax under income from other sources. I repeat again, interest on employee contribution, it is taxable under income from other sources. And finally, last one, employer contribution and interest on employer contribution. These two are taxable under salaries. Employer contribution, what is that line? Employer contribution and interest on employer contribution. These two are taxable under salaries. Are we getting clarity on this point, my dear friends? So employee contribution is not taxable. Interest on employee contribution will tax under income from other sources. Employer contribution and interest on employee contribution is taxable under income from salaries. So that is the story of tax treatment of Provident Fund. Now why did I tell all these points to you? Because section 7 is related very much to that. First point talks about what? Employer's contribution to RPF, recognized provident fund, in excess of 12% of salary. We discussed this point. Second, interest credited to RPF balance in excess of 9.5% per annum. We discussed that as well. Next one, transfer balance from an unrecognized provident fund to recognized provident fund. Only the employer's contribution plus interest thereon. So transferring from URPF to RPF, we know that employer contribution plus interest will be taxable under income from salaries. Contribution by central government or any other employer in the tax year under notified pension scheme. So in simple terms, employer contribution to pension scheme of central government. Employer contribution to pension scheme of central government. See here, important points. Section 7 of Income Tax Act 2025 is titled Income Deemed to be Received and Dividend Deemed to be Income. Alongside the deemed receipt items above, it also treats dividend as income of the tax year. Got it, friends? Good. So section 7 deals with the concept of what? Income deemed to be received in India, and also deals with the concept of dividend income. So that is the story of what, my dear friends, section 7, important discussion. Next, section 9, which talks about income deemed to accrue or arise in India. This is also very, very important. Why this is also very, very important? Because Indian income means that income which is accrued or received or deemed to be received or deemed to accrue or arise in India. Indian income is that income which is accrued or received or deemed to be received or deemed to accrue or arise in India. And if income is Indian income, we will tax it for ROR, RNOR and NR. If income is foreign income, we will tax only for ROR, and we will also tax for RNOR in two cases. What are two cases? Business income, which is controlled wholly or partly from India. Professional income, which is set up in India. So let's understand what is covered in section 9. What we will do is, before I get on with section 9, let's discuss some questions. Then we'll come back to section 9. Makes more meaningful sense. Yeah? Get back. See here, first question. An individual who is an Indian resident is allowed to hold two different citizenships simultaneously. Is citizenship a determining factor for residential status of an individual? Come on. What is the answer, my dear friends? What is that they have asked? They have asked very clearly, is citizenship a determining factor for residential status? The answer is, under income tax law, residential status is determined based on duration of stay in India. I repeat one more time, my dear friends. Residential status is determined based on what, sir? Duration of stay in India. But not based on citizenship. Citizenship is irrelevant for determination of residential status. It is irrelevant for determination of residential status. Next question. Next question, answer also I gave there. Please carefully concentrate. Brett Lee, an Australian cricket player, visits India for 100 days in every financial year. This has been his practice for the last 10 years. Find out residential status for tax year 26-27. Straight answer, 100 days every year. Same question I already solved for you. He will become resident but not ordinarily resident. He will become resident because he can satisfy second basic condition. But he cannot satisfy both additional conditions together, because second additional condition says what? 730 days or more during the last 7 years preceding the tax year. 730 days is what we want in last 7 years. When you say 100 days every year, in last 7 years it becomes 700 days. So obviously he can't satisfy both additional conditions together. And the residential status will become resident but not ordinarily resident. Next point. Would your answer change if the facts relate to Srinath, an Indian citizen who resides in Australia and represents Australian cricket team? That means what? He is an Indian citizen who is coming to India for a visit during the tax year. If he is an Indian citizen, I already told you, my dear friends, unless question specifies, don't assume he is an Indian citizen. Here question has specifically given that he is an Indian citizen, he is coming to India for a visit during the tax year. Then what will happen only? We will apply only first basic condition. What is first basic condition? 182 days or more during the tax year. Is he satisfying that? No. So the answer will be non-resident. Next. Third case scenario. What if Srinath had visited India for 120 days instead of 100 days every year, including 26-27? Sir, let us say if he is an Indian citizen and total income other than foreign source is greater than 15 lakhs, then he will be RNOR. The reason, because we will come under section 6(5). Indian citizen or a person of Indian origin who is coming to India for a visit during the tax year and his total income is more than 15 lakh rupees. Then he can either satisfy 182 days condition or he can satisfy second modified condition. What is that second modified condition? 120 days or more during the tax year and 365 days or more during the 4 years preceding the tax year. See here, first case, he is a resident but not ordinarily resident, because 700 days only, and what we want is 730 days. You need to present like this in the examination. Second bit. If it relates to Srinath, Indian citizen, who is in Australia, who comes on a visit to India, he will be a non-resident irrespective of his total income. His stay of 100 days is in any case less than 120 days. Last case. If Srinath's total income other than foreign sources exceeds 15 lakh rupees, he is a resident but not ordinarily resident. He stays 120 days in the tax year, and in last 4 years also it is more than 365 days. And if his total income does not exceed 15 lakhs, he is a non-resident, since 120 is less than 182 days. Very, very interesting question. Makes sense, right, everybody? All of us. Wonderful. Next question, guys. Question number 3. Please see that. During tax year 26-27, X, a foreign national who is not a person of Indian origin. He is not Indian citizen. I repeat, he is not Indian citizen, he is not person of Indian origin. If he is not Indian citizen and if he is not person of Indian origin, that special cases of 63, 64, 65 will not come into picture. We will just restrict to 62 only. Both basic conditions are available. Visits India for 100 days. Determine his residential status for tax year 26-27. Given that in 25-26 he was in India for 350 days, and 24-25 and 23-24 he was in India for 15 days and 366 days respectively. Come on, friends. Mr. X is not an Indian citizen and not a person of Indian origin. Mr. X is not an Indian citizen and not a person of Indian origin. Hence, section 6.3, 6.4 and 6.5 does not apply. And residential status is determined by applying provisions of section 6.2. And what is the line next? As per section 6.2, an individual shall be regarded as resident. Come on, friends, what is the line? An individual shall be regarded as resident if he satisfies any one of the basic condition. Satisfy any one of the basic condition. Now tell me, my dear friends, tell me what is given in the question. In tax year 26-27, how many days is there in India? In tax year 26-27, he is there in India for how many days? 100 days. 25-26, 24-25, 23-24. That data is also available. 25-26 is there for 350 days. 350 days. Next, 24-25, 15 days and 366 days. 15 days, next 366 days. So that is the story of his duration of stay in India. That is the story of how long he is there in India. Now tell me, my dear friends, 350 plus 15 plus 36. Prior period, nothing is available, so I'll write it as nil. Friends, speak out. So what is the story? Total how much? 365 plus 366. Total is coming to 7. 31 days, if I am not wrong. 350 plus 15 is 365. 365 is 730. 731 days. Now tell me, my dear friends. Mr. X can satisfy second basic condition. He can satisfy what, sir? Second basic condition, and can also satisfy both additional conditions together. He can satisfy second basic condition and can also satisfy both additional conditions together. Hence, Mr. X shall be regarded as resident and ordinarily resident. So for the sake of clarity, how to present in the examination, I wrote all the points. And this is how you have to present in the exam. Only then proper full marks will come. Please don't lose the marks just like that, even when you know the concept. When you know the concept, it is important that you present the concept properly, so that best marks will come in the examination. Clear, guys, everyone? Please speak out. Come on. Next question. Question number 4. X was born in Pune in 1980. He migrated to Australia in December 2025 and took citizenship with effect from 1st January 2026. That means what? This guy X, he is not Indian citizen and he is not person of Indian origin, because we treat a person as person of Indian origin only if he or any of his parents or any of his grandparents were born in undivided India. See next. He migrated to Australia in December 25 and took citizenship there with effect from 1st Jan 2026. His parents were born in Nasik in 1950. 1950 means after independence, it's not undivided India. But his grandparents were born in Sydney. So neither himself nor his parents nor any of his grandparents were born in undivided India. So answer is very clear that he is not a person of Indian origin. Next. He comes to India on 15th February 2027 for a visit of 190 days. He came on 15th February 2027 for a visit of 190 days. But don't just get carried away by the word called 190 days, because what is important is not just how many days he has come. What is important is how many days he has come during the tax year. Sir, I repeat again, what is important is not just how many days he has come. What is important is how many days he has come during the tax year. During the tax year, how many days he is present, that is the key. That is important for us. Find his residential status for the tax year 26-27, assuming that before 2026, he was present in India for at least 275 days every year. So, if he is there in India for at least 275 days every year, he can easily satisfy additional conditions. But the question is all about basic conditions. Correct, no? Now, Mr. X is not an Indian citizen and not a person of, he is not Indian citizen and he is not a person of Indian origin. Come on friends, what is the line? He is not an Indian citizen and not a person of Indian origin. And when he is not an Indian citizen and he is not a person of Indian origin, accordingly, special cases under section 63, 64, 65. 63, 64, 65 does not apply, and residential status is determined by applying provisions of section 6(2). By applying provisions of what, my dear friends? Section with section 6(2). Now here listen, carefully listen. By applying with section, my dear friends, section 6(2). Now carefully listen. What is happening here? 6(2) has got two basic conditions. What is that? He must be in India for a period of 182 days or more during that tax year, or he must be in India for a period of 60 days or more during that tax year, and 365 days or more during the 4 years preceding the tax year. Now here, if you observe carefully, he has come to India on 15th February 2027 for a visit of 190 days. Sir, please understand, he might have come for 190 days. I am not denying the fact. See, please listen. Please listen. He might have come for 190 days. I am not denying that fact at all. I am not denying the fact at all. He might have come for 190 days. But the whole point is all about during the tax year, how many days is there? During the tax year 26-27, during the tax year 26-27, he is in India from 15th February 2027 to 31st March 2027. 15th February 2027 to 31st March 2027. How much it is coming to? February 14 days plus 31 days in March, which is coming to 45 days. That's it. He is in India only for a period of 45 days during the tax year. Sir, in the question, by just plain reading of the question, you might get confused by seeing that word called 190 days and jump to a conclusion that he is a resident. But the point to be noted very clearly is not how many days he has come, but the point to be noted very clearly is how many days he has come during the tax year. During the tax year, he is there only for 45 days. Hence, Mr. X cannot satisfy any of the basic condition given under section 6(2) and shall be regarded as a non-resident. He cannot satisfy any of the basic condition given under section 6(2) and shall be regarded as what, my dear friends? Non-resident. That is a point to be noted. Friends, are we getting clarity, everyone? Please speak out. So that is the story of this question number 4, where he is a non-resident. By just seeing 190 days, our brain might start telling he is a resident, but the answer is non-resident. See how careful you have to be. You cannot just like that come to conclusions. Next question you see. 5th question. X is a foreign citizen. That means he is not Indian citizen. And question will tell you if he is an Indian citizen. If question is silent, don't assume that he is an Indian citizen. His parents and grandparents were not born in undivided India. That means he is not a person of Indian origin. So special case in 6(3), 6(4), 6(5) will not apply. However, his relatives, brother, sister, mother, all were born in undivided India. All that is irrelevant for me. Because what is relevant is only himself or parents or any of his grandparents were born in undivided India. See next. During 26-27, how many days is in India, my dear friends? He is in India for 147 days. Next. 1, 2, 3, 4. All 4 years put together, How many days is there? 140 plus 300 is how much? 440. 440 plus 25 is 465. 467. 497. 497 days. And they are asking the question, find out his residential status. My answer is RNOR. The reason because he can satisfy second basic condition, but he cannot satisfy both additional conditions together. Because second additional condition clearly says 730 days or more during the last 7 years preceding the tax year. 730 is not satisfied. So he can satisfy second basic condition and we will treat him as resident. But he cannot satisfy both additional conditions together. That is the concept. Makes sense, everybody? Please reply. Good. Next question. Question number 6, my dear friends. Please see that. X 44 years is a citizen of India. In question they clearly told Indian citizen. He leaves India for the first time on 20th September 2025. That means which tax year? 25-26. He is leaving India to work on an overseas project of his employer company, ABC Limited, an Indian company. That means what? He is an Indian citizen who is leaving India for the purpose of employment outside India, covered in section 6.3. So for 25-26, we have to apply special case. And he returns on 10th October 2026. 10th October 2026, he came back to India. When I say he came back to India, he has not come to India for a visit. He has come back to India permanently. So we will not apply special case. Special case will apply only when Indian citizen or person of Indian origin is coming to India for a visit. In 26-27, he has not come for the purpose of visit. Find his residential status for 25-26 and 26-27. Listen now. First, let me talk about 25-26. Now, during tax year 25-26, he left India. For the purpose of, come on friends, he left India for the purpose of employment outside India. He left India for the purpose of employment outside India. Accordingly, section 6.3 will apply and he will be regarded as resident only if first basic condition is satisfied. And what is that first basic condition? He must be in India for a period of 182 days or more during the tax year. Now, he left India on which date, my dear friends? 20th September 2025. So, how many days is in India, my dear friends? April 30 days, May 31, June 30, July 31, August 31, September 20. Come on, see here. He left India on 20th September 2025. That means what? He is there from April 1st, 2025 to 20th September 2025. April 30 days, May 31 days, June 30 days, July 31, August 31, September 20. How much it is coming to? 30 plus 31 plus 30 plus 31 plus 31 plus 20. Total is coming to 173 days. And hence, Mr. X is regarded as non-resident for tax year 25-26. That is the concept. Make sense, guys? Everybody, sir. An interesting question actually. Let me talk about now tax year 26-27. Tax year 26-27. Mr. X has come back to India. Mr. X has what, my dear friends? He has come back to India. That's what they told in the question. He returns on 10th October 2026. He has come back to India and not for the purpose of visit. Hence, section 6(4) will not apply. And residential status is determined by applying. Residential status is determined by applying provisions of section 6(2). The moment I say section 6(2), my dear friends, that means what? If you satisfy any one of the basic condition, you are regarded as a resident. What are basic conditions? He must be in India for a period of 182 days or more during the tax year, or he must be in India for a period of 60 days or more during the tax year and 365 days or more during the 4 years preceding the tax year. Now tell me, he has come back to India on which date? Come on, already we have seen that. He has come back to India on 10th October 2026. So during tax year 2026-2027, he is in India for how many days? Come on, October, how many days? 10th he has come back. So October totally we have 31 days. So 22 days he is in October, in India in October. November 30, December 31, Jan 31, Feb 28, March 31. 22 plus 30 plus 31 plus 31 plus 28 plus 31, which is coming to 173 days only. Hence, he can satisfy second basic condition and also additional conditions under section 613. Now don't ask me, sir, how do you know he can satisfy additional conditions? How do I know? I should tell. Come on, see now, I'll tell you how do I know. In the question they told he leaves India for the first time. You saw that word first time? That means what? Prior to that, he was always in India. When prior to that, he was always in India, obviously he can satisfy additional conditions. And shall be regarded as ROR, that is resident and ordinarily resident. So that's the story of this very interesting question. And I'm sure it makes sense for all of us, my dear friends. So resident status is an important topic. We still have lot more wonderful questions to solve. Let's do that. Friends, next question, my dear friends, please see this. This is very interesting question. X is a citizen of Pakistan. So the question only they told that he is not an Indian citizen. His maternal grandfather was in a village near Karachi in 1933. That means what? His maternal grandfather was born in undivided India. So Mr. X will definitely become a person of Indian origin because his maternal grandfather was in a village near Karachi in 1933. Indian citizen or a person of Indian origin. We know special case, no? So special case of section 6(4) will come into picture. He comes to India on 7th April 2026 to complete a foreign assignment of his employer company and goes back on 4th June 2026. Mrs. X is a resident in India for tax year 26-27. That is irrelevant for us. That is absolutely irrelevant for us. Prior to 7th April, he was in India as follows. All that details they have given. So first let's find out the residential status. Sir, during tax year 26-27, what has happened here? Come on, please see here. He has come to India on 7th April 2026 to 7th April 2026 to 4th June 2026. For that period, he is in India. 7th April 2026. April, how many days we have totally? April, we have 30 days. So, 24 days in April, because day of coming, day of going is always included. 24 days in April, correct, no? 24 days in April, 31 days in May, and 4 days in June. 24 plus 31 plus 4, which is coming to 59 days. Understanding, my dear friends? And since it is 59 days, my dear friends, Mr. X cannot satisfy basic condition, and shall be regarded as non-resident. So come on friends, what is the answer we got? He is regarded as non-resident. And now tell me, once he is a non-resident, what will happen, my dear friends? Come on. Once he is a non-resident, what will happen? Only Indian income is taxable. As per section 5, we know the concept very clearly that only Indian income is taxable. There is no second thought about it. And Indian income means what? Income accrued or received or deemed to be received or deemed to accrue or arise in India. Only Indian income will be taxable. Come on, see below. Salary from a Pakistani company received in Pakistan, service also rendered in Pakistan. So what kind of income is this? This income is a foreign income and it is not taxable. Next, salary from Pakistani company received in Pakistan but service is rendered in India. Sir, once service is rendered in India, it becomes an Indian income and it is taxable because an income is regarded as Indian income if it is accrued or received or deemed to be received or deemed to accrue or arise in India. Next point. Business income. Business is in UAE, partly controlled from Pakistan and partly from India. And entire income is received in UAE. Since business is in UAE, it is accrued in UAE. Income is received also in UAE. It is definitely a foreign income. And again the answer is not taxable. Even though it is controlled partly from India, still it is not taxable. The reason being very clear that business income controlled wholly or partly from India, professional income set up in India, it is taxable only in case of RNOR. But in this case, our friend is a non-resident because he has come to India on 7th April 2026 and he goes back on 4th of June. So in April he is there for 24 days, May he is there for 31 days, June is there only for 4 days. So technically he is there only for 59 days. So he cannot satisfy any of the basic condition. Next, rental income from property. Next point, rental income from property in Mumbai received in Pakistan. This is definitely an Indian income and it will be taxable. Why it is Indian income? Because property is in Mumbai. Next question. Business income. Business is in UK, partly from UK and partly from Pakistan. Received also in UK. Later on, 50,000 remitted to India. It is foreign income and it is not taxable. Moreover, one important point I will tell is that remittance is not equal to receipt. Receipt always means first receipt. Remittance is something like a transfer. Remittance is something like a subsequent transfer. Understanding, friends? Very good. Next point. Birthday cash gifts received in India. The moment we say in India, it is definitely taxable as it is an Indian income. And under income tax law, my dear friends, if the gift is greater than 50,000 per annum, it is definitely taxable. And if it is more than 50,000 per annum, I repeat, if it is more than 50,000 per annum, entire gift is taxable. In our example, in our question, it is 74,000. It is 74,000 doesn't mean that 24,000 is taxable. If it is 74,000 gift, entire 74,000 is taxable, not excess. Not excess, entire amount is taxable. Very interesting point. Clear, everybody? Next. 8th question requires some more knowledge. 10th also requires some knowledge. 12th also requires some knowledge. Look at 13th question, my dear friends. Mr. Anand is an Indian citizen and a member of crew of a Singapore-bound Indian ship. That is, it is going from India to Singapore, carrying passengers in the traffic, international traffic, departing from Chennai on 6th June. From the following determined resident status for the tax year 26-27, assuming his stay in India in last 4 years is 400 days. So we are talking about section 6, 3 and also read with 6.6. 6.6 clearly says date of joining till the date of signing off shall be excluded for calculation of number of days in India. And 6.3 says he must be in India for 182 days or more during the previous year. Joining is when 6th June. Signing off is when 9th December. So 6th June to 9th December is excluded from his stay in India. So 6th June means 25 days in June, 31 days in July, 31 days in August, 30 days in September, 31 days in October, 30 days in November, 9 days in December. Total 187 days we will treat as if he is not in India. The balance period is 178 days. And since 178 days is less than 182 days, Mr. Anand is a non-resident for tax year 26-27. That is the story of this question number 13. 14 we'll see later. That's it. So we are done with some interesting questions. We are required to discuss some more concept, that is section 9. After we discuss section 9, we can discuss the balanced questions, my dear friends. Are we clear till this stage, everybody? Come on, let's proceed. So friends, come on. We have been discussing the concept of residential status and scope of total income, wherein we covered some very interesting questions. Now it's time to talk about the last section in this topic, section 9. Which deals with the concept of income deemed to accrue or arise in India. And this concept is important for a simple reason that we have two types of income, Indian income and foreign income. And if income is Indian income, it is taxable for ROR, RNOR as well as NR. And if income is foreign income, it is taxable for ROR and taxable even for RNOR also in two cases. Number one, business income, which is controlled wholly or partly from India. Number two, professional income, which is set up in India. That's the reason why it is important to have a clarity of thought on what is that concept of income deemed to accrue or arise in India. Let's talk in detail. And once we complete this section, we have few more questions to solve. Even that will solve and complete. And in this topic, we discussed about section 5, scope of total income. We discussed about section 6, residential status for different type of persons. We discussed about section 7, income deemed to be received in India. Now we are trying to understand section 9, income deemed to accrue or arise in India. That means even though income is accrued outside India, it is still deemed to be accrued or arised in India. That is the concept. Say now, income deemed to accrue or arise in India. Which section, my dear friends? Section 9. Section 9 lays down source rules. Certain incomes are deemed to accrue or arise in India even if earned or received outside India. So this mainly affects whom, my dear friends? Non-residents. So if income is deemed to accrue or arise in India, it becomes Indian income and it is definitely taxable even for non-resident. Because once income is Indian income, it is taxable for ROR also, RNOR also and even NR for that matter. Come on, let's see. These are all various types of incomes what we have. One by one we'll talk in detail. First point, income from business connection. Let me explain to you first, then we can go through there. Sir, we are talking about something called section 9, which deals with the concept of business connection, which deals with the concept of, let me write first this, incomes deemed to accrue or arise in India. As name itself says, we are talking about something called incomes which are deemed to accrue or arise in India. It is not arised in India, it is not accrued in India, but it is deemed to be accrued in India. Listen very clearly the point. Sir, the first point talks about something called income from business connection in India. What is the point, my dear friends? Income from business connection in India. This point is important. I'll tell you why. Because business income of a non-resident, what income, my dear friends? Business income of non-resident is deemed to accrue or arise in India if non-resident has business connection in India. So if non-resident has business connection in India, then the business income of non-resident is taxable in India. Come on friends, what is the line I just told? Business income of a non-resident, one more time I repeat, what is the line? Business income of a non-resident is taxable in India. Business income of a non-resident is taxable in India only if the non-resident has business connection in India. Business connection in India covers various circumstances. And if you have business connection, only then business income of non-resident is taxable. Very, very important points. Come on, see that. Any income arising directly or indirectly from any business connection in India is deemed to be earned in India. A business connection includes business activity carried on through a person who is acting on behalf of non-resident. What is that he is doing? Three interesting points we have. Number one, has and habitually exercises. Habitually means usually, generally exercises an authority to conclude contracts. Very, very important word. There is an agent in India for the non-resident. There is an agent in India for the non-resident, and that agent in India is concluding the contracts on behalf of non-resident. Has an authority to conclude contracts in India, or habitually concludes contracts, or plays the principal role leading to their conclusion, where such contracts are in the name of non-resident, or for the transfer or right to use property owned by non-resident, or for provision of service by non-resident. So basically what is happening here is, there is a non-resident. This non-resident has got agent who is in India, and this agent is somebody who is concluding contracts on behalf of non-resident. If this agent has got a power to conclude contracts on behalf of non-resident, then we say that non-resident has business connection in India. And this concept is important for a simple reason, because business income of non-resident, what is that line? Business income of non-resident is taxable only and only if non-resident has business connection in India. Come on friends, what is the line? Business income of non-resident is taxable if and only if non-resident has business connection in India. That's where this point is important. Next point. Has no such authority but habitually, that means what? Usually maintains in India a stock of goods from which they regularly deliver on behalf of non-resident. First possibility is what? Non-resident is having an agent in India who is concluding contracts on behalf of non-resident. Second, non-resident has an agent in India who is maintaining stock of goods on behalf of non-resident. Third one, habitually secures orders. What is that line, my dear friends? Habitually secures orders in India mainly or wholly for the non-resident or for that non-resident together with other non-residents under the same common control. So that is the story of these three interesting points in business connection. We still have some more points there, we'll talk, but primarily these three are major points. What is that point, my dear friends? If non-resident has business connection in India, then that income is deemed to accrue or arise in India. And why this concept is important? Already I told you that business income of a non-resident, what is that like? Business income of a non-resident is taxable in India only if the non-resident has business connection in India. Business connection means having an agent in India who is concluding contracts on behalf of non-resident. Second, who is maintaining stock of goods. Number three, who is securing orders. Next point. Where a person secures orders for other non-resident, a business connection is established for those others if such other non-resident controls, is controlled by or is under the same control as first non-resident. In each case, how much is taxable? Only so much income as is attributable to operations carried out in India is deemed to accrue or arise in India. That means we will not tax non-resident global income. One more time I repeat, we will not tax non-resident global income, we will tax only that extent of income which is attributable to India, not total income. Next line. Significant economic presence. This is one latest concept and interesting point. Please see that. If non-resident has significant economic presence, then also we say that non-resident has business connection in India. Please see that. Significant economic presence of a non-resident in India also constitutes a business connection. Now, what is that significant economic presence? Transaction in goods or services or property is carried out by the non-resident with any person in India, including download of data or software sitting in foreign. Some online apps are created and in Indian people are accessing that apps and making use of it. So somebody is sitting in foreign, he is making money out of it. And the aggregate payment in the tax year exceeds 2 crores. So if the non-resident is doing business of more than 2 crores with Indian persons, then we say that the non-resident has significant economic presence in India. Next. Systematic and continuous soliciting of business. Soliciting means procurement, asking for business, or interaction with users in India. Users in India are at least 3 lakh rupees. Then also we say that non-resident has significant economic presence. And if there is significant economic presence, it is treated as a business connection. Next slide. These constitute SCP whether or not agreement is entered in India, the non-resident has a residence or place of business in India, or the non-resident renders service in India. Whether service is rendered in India, service is rendered outside India, agreement is entered in India, agreement is entered outside India, residence is in India, residence is outside India. Whatever circumstance it is still regarded as significant economic presence if any of the above situation is satisfied. That is, when we look at the terms of transaction, it is more than 2 crores aggregate payments in a tax year. And if you look at the user perspective, users are at least 3 lakhs. Only income attributable to such transactional activities is deemed to accrue as in India, obviously. Next, what is not a business connection? Income that cannot be attributable to operations in India for a business other than one with business connection on account of SCP. Next, purchase of goods in India for the purpose of export. Government is very, very happy. Next, collection of news and views. News and views. Views means opinions of persons. Collection of news and views for transmission outside India by a non-resident news agency or publisher. So there is a non-resident magazine or non-resident television channel. They are collecting news or views from India for transmission outside India. we should feel proud a non-resident business magazine or a non-resident television channel is collecting news or views from India and they are transmitting outside India. Next line. Shooting of a cinematograph film in India, it's a proud moment. If the non-resident is an individual, he should not be a citizen of India. If it is a firm, there should not be a partner who is citizen or resident of India. If it's a company, no shareholder is a citizen or resident of India. Next point. A foreign company engaged in mining of diamonds. I repeat the line. A foreign company engaged in what, friends? Mining of diamonds. No income is deemed to arise from activities confined to display of uncut and unassorted diamonds in special notified zone. So no income is deemed to arise from what, my dear friends? From an activity which is just confined to what? Display of uncut and unassorted diamonds in special notified zone. So that is the story of what, my dear friends? Business connection. And a non-resident business income is taxable. A non-resident business income is taxable only and only if non-resident has business connection in India. Next point. Other incomes deemed to accrue or arise in India. First point. Property, asset or source of income situated in India. Income arising from any property, movable or immovable, tangible or intangible. Asset or source is situated in India. If income is coming from property in India, it is deemed to arise in India. Next point. Transfer of capital asset situated in India. If asset is in India, obviously it is deemed to arise in India. Next line. A share or interest in a foreign company or entity is deemed to be in India if it derives directly or indirectly its value substantially from assets located in India. Indirect transfer. Here what is happening is, let me explain that to you. There is one foreign company which is holding shares in another foreign company which is holding shares in Indian company. And what is happening is, this foreign company is transferring shares to another foreign company of a foreign company. So one foreign company is transferring shares of a foreign company to another foreign company. India is never involved, but still it is deemed to occur in India if this foreign company derives its value, if this foreign company derives its value substantially from assets located in India. So if the foreign company derives value from substantially from assets located in India, then it is definitely deemed to occur in India. See that line? A share or interest in a foreign company or entity is deemed to be situated in India if it derives directly or indirectly its value substantially from assets located in India. So if value is derived substantially from assets located in India, then definitely it is deemed to occur in India. Next point. However, dividend declared and paid by foreign company outside India on shares that derive value from Indian assets is not deemed to occur in India. Dividend is not taxable, but capital gains is taxable. Next, income under the head salaries. Income for services rendered in India is regarded as earned in India, whether paid in India or outside India. It also covers salary for the rest or leave period that is preceded and succeeded by service rendered in India. Sir, once service is rendered in India, definitely that income is deemed to accrue or arise in India. There is no second thought about it. Next line. Salary payable by Government of India to an Indian citizen for services outside India. Let me explain that to you here. Let us say, for example, my dear friends, there is Government of India. Come on, who is there? Government of India. Now, there is one person, Mr. X, who is an Indian government employee. There is one person, Mr. X, who is an Indian government employee. and this person X is working in US, payment also received in US. Now from X point of view, what they told in the law is that income is accrued in US, received also in US. Accrued in US, received also in US. Still it is deemed to accrue or arise in India. So if you observe carefully, what is happening here? It is accrued in US. One more time I repeat. It is accrued in US, received also in US. Income is accrued in US, income is received also in US, but still it is deemed to accrue or arise in India. The reason because salary is paid by government of India to an Indian citizen working outside India. Here important condition is that Mr. X should be an Indian citizen. But one more special point is there in the law which says that allowances and perquisites. So allowance is something like a fixed amount given for some purposes. Perquisite is like a benefit given, like some facilities, rent-free allowance, rent-free accommodation, house rent allowance, mobile facility, car facility, whatnot. So many facilities might be given by employer to employee. Allowances and perquisites will be exempt. So, what is the concept here? Salary paid by, one more time I repeat, salary paid by government of India to an Indian citizen who is working outside India is definitely deemed to accrue or arise in India. However, allowances and perquisites are exempt. Salary payable by government of Indian citizen, government to an Indian citizen for service outside India. It is deemed to accrue or arise in India if the income is chargeable under what, my dear friends? Salaries. And the recipient is an Indian citizen. The services are rendered outside India and the payer is government of India. Allowances and perquisites paid abroad by the government are exempt. Next point. Dividend paid by an Indian company outside India. Once dividend is paid by Indian company, it is deemed to accrue or arise in India. That's it. Finally, the last important discussion, that is about interest, royalty and fees for technical services. Let me explain that to you. Listen. Carefully listen. One person, Mr. X, an Indian resident. Now, there is one person, Mr. Tom. One person, Mr. Tom of Singapore, who is one top architect. Okay. Now what has happened is, Mr. X has approached Tom of Singapore. Mr. X personally went to Singapore to meet Tom, to get a design for a hotel, to be set up in India. Come on, who has contacted whom, sir? X, an Indian resident. He went to Singapore to meet Tom and he has taken design for the hotel to be set up in India and paid $10,000. Now what is the point is, technically this is like a technical service or a professional service. Now the point to be noted here is, from Tom's perspective, my dear friends, come on, from Tom's perspective, one more time I repeat, my dear friends, one more time I repeat, From Tom's perspective, income accrued where? Singapore. Income accrued in Singapore. Income received also in Singapore. Income accrued in Singapore, income received also in Singapore. But law is telling it is deemed to accrue or arise in India. Deemed to accrue or arise in India since benefit of, I'll repeat that line, since benefit of technical service, since benefit of technical service is utilized in India. Since benefit of technical service is utilized in India. Even though income is accrued outside India, received outside India, still it is deemed to accrue as in India because benefit is utilized in India. And this concept is only in case of IRF. Why I say IRF? Because interest, royalty and fees for technical services. It will apply only in this particular context. See now, interest, royalty and fees for technical services. If it is payable by government, that means payment is made by government of India, it is always deemed to accrue as in India. No discussion at all. If it is payable by a resident of India, deemed to accrue as in India, except when used for business or profession carried on outside India or earning income from any source outside India. Same concept. So if the benefit is utilized for business outside India, it is not taxable. If it is utilized for business in India, it is taxable because it is deemed to accrue as in India. Once it is deemed to accrue as in India, it is Indian income and taxable for all. Last point, payable by non-resident. It is deemed to accrue as in India only when used for the business or profession carried on in India or earning income from any source in India. So that is the story of this interest, royalty and fees for technical services. So interest payments that are not taxable. Any interest, royalty, technical fee paid by resident to non-resident for a business or profession carried on where, sir? Outside India. If it is for business or profession carried on outside India, that is not taxable. Any interest, royalty or technical fee paid by a non-resident to a non-resident for business or profession carried on where? Outside India. If it is outside India, it is not taxable, friends. What is royalty now? Any consideration, including lump sum, but excluding capital gains, for transfer of rights. For transfer of rights in a patent, invention, model, design, secret, formula, process, trademark, imparting information on their working, use of property, imparting technical, industrial, commercial, scientific, experience, skill, industrial, commercial, scientific equipment, transfer of rights in a copyright, literary, artistic, scientific work, including films, tapes for a TV or radio, consideration for sale, distribution or exhibition of cinematograph films. So royalty is basically paid for use of some right, in simple line. Computer software, consideration, this is important, please see that. Consideration for use or the right to use computer software including a license through any medium is also royalty. Consideration for use or the right to use computer software, that is also regarded as royalty, my dear friends. So that is the story of this interesting concept of section 9, income deemed to accrue as in India. Important discussion because income deemed to accrue as in India is known as Indian income. Once it is Indian income, it is taxable for everybody. ROR, RNOR, NR. That is the story of this concept of residential status and scope of total income. But we still have a few more questions for practice. We'll solve that and then complete this topic. Come on friends, let's see the balance interesting questions in this particular topic of residential status and complete this topic, my dear friends. Come on, see that. X is a citizen of South Africa. That means what? He is not an Indian citizen. If he is not an Indian citizen, special case will not apply. He comes to India for the first time for a visit of 250 days. He would have come for 250 days, but during the tax year, how many days is there? That is important. On 10th December 2026, when 10th December he has come, my dear friends, we have to technically see from 10th December to 31st March. So December, technically 22 days in December, because 31 days in December, 10th year has come. Clear, right? 22 days in December, 31 days in Jan, 28 days in February, 31 days in March. 22 plus 31 plus 28 plus 31, which is coming to total 112 days. And the problem here is he has come to India for the first time. If it is first time, then he can't satisfy 60 and 365 also. He can't satisfy 182 days condition also. Then definitely our friend Mr. X will be a non-resident. And the moment we conclude that he is a non-resident, what will happen, my dear friends? The moment we conclude that he is a non-resident, only Indian income will be taxable, because non-resident is taxable only in respect of Indian income. Are we all getting clarity, everybody? Please speak out. Come on, see the point. Technical fees from Government of South Africa received in UK. What is the answer then? Not taxable. Technical fees from Government of South Africa received in Chennai. Then definitely this will become taxable. Technical fees from Government of India, without any discussion, we will tax it because it is received from Government of India. Next, fees from Y resident, which is paid outside India for service rendered outside India. Benefit is utilized by Y for business in India. Again, this will become taxable. Next, fees from Z, a resident, paid outside India for service rendered outside India. Benefit is utilized for business in Bhutan. This is not taxable. So we clearly discussed that in case of interest, royalty, technical services, if it is utilized for business in India, then it is taxable. If not, it is not taxable. Fees from A, paid outside India for service rendered outside India. Benefit is utilized for business in India. This will definitely become taxable. Fees from B, resident, which paid outside India for service rendered outside India. Benefit is utilized for B for business in Bhutan. This is also not taxable. So that is the story of this interesting question. Question number 8. How do we determine the total income? Clear? Next. 9th question I will see slightly later. 10th also slightly later. Directly come to 14th question, friends, once. Because related to technical service only. Miss Vivita paid $5,000 to Mr. Kulashekara, a management consultant practicing in Colombo, who specializes in project financing. The payment was made in Colombo. Where is payment made? Colombo. Kulashekara is a non-resident. The consultancy relates to a project in India. There ends the story. Is this payment chargeable to tax in India in his hands, since the services were used in India? 100% answer is yes. Since it is related to business in India, it will definitely be taxable, and the income is deemed to accrue or arise in India. Are we all getting clarity, everybody, sir? Very interesting concept, no doubt about it. Fully clear? Good. Next. Get back, my dear friends. Let's see question number 9. Mrs. Geeta and Mrs. Leena are sisters. Geeta is settled in Malaysia since 1985 and visits India for a month every year. Only for 1 month she is coming. So she cannot satisfy any of the basic condition and she will become non-resident. Mrs. Leena is settled in Indore since her marriage in 1994. So she will definitely become an ROR. So based on type of income, you decide the taxability. First one. Income from profession in Malaysia, set up in India, received there. Answer is not taxable. If Geeta would have been RNOR, we would have taxed, but Geeta is NR. Profit from business in Delhi. The moment the business is in Delhi, it will become taxable. Rent computed from property in Malaysia, deposited in a Malaysian bank, later remitted to India. Remittance is not relevant for us. What is relevant is only accrued and received. It is accrued in Malaysia, received also in Malaysia. So it is foreign income. It is not taxable. Dividend from PQ Limited Indian company, this will be taxable. Dividend from Malaysian company received in Malaysia, it is not taxable for Geeta, but it is taxable for Lena, because Lena is a ROR. Come on friends, next point please. Cash gift received from a friend on birthday, this is not there, 51,000, this is taxable because it is greater than 50,000. Agriculture income from a land in Maharashtra, let me tell you my dear friends, this is exempt. Agricultural income from a land in India is exempt. Past foreign untaxed income brought to India, this is not an income. I taught this point to you while teaching the concept very clearly that past untaxed income brought to India, old income which is brought to India is not taxable for current year, because for the current tax year it is not an income. Next point. Fees for technical services rendered in India, received in Malaysia. Since it is rendered in India, it will be taxable because accrued in India. Income from business in Pune, Geeta receives 50% in India. Even though 50% in India, total amount is taxable because business is in Pune, accrued in Pune. Interest on debentures of Indian company. Once it is debentures of Indian company, it is taxable. Short-term capital gain on sale of shares of Indian company, that is also taxable. Interest on savings account with SBI, this is also taxable, but after taking it as income, we can take deduction under section 153 also. Life insurance premium paid to LIC 30,000, we can take deduction under section 123. But the concept to be noted very clear that this 123, 153 deductions story will come only and only if we are opting out of default tax regime. Because in default, we don't get majority of deductions. So that is the beauty of this very interesting question, guys. Clear? Let's proceed. Next question, my dear friends. Determine the taxability for tax year 26-27 for the following incomes in the hands of individual who is ROR, RNOR, NR. So basically we are trying to talk about taxability for ROR, RNOR, NR. First point, salary received in Canada for service rendered in Bangalore. What will happen? Will taxable for all. Capital gain on sale of house in Surat. House in Surat, so definitely taxable for all. Dividend from foreign company received in Canada, we will tax only for ROR. Business income in London, which is controlled from Mumbai, and 1 lakh is received in India. So what will happen is, for ROR, we will take it 4 lakhs. RNOR also will take it 4 lakhs. The reason because RNOR also taxable because business is controlled from India. And NR also we will take 1 lakh because 1 lakh is received in India. Superb concept. Profit from business in Indore managed entirely from Canada. Since business is in Indore, my dear friends, it is taxable for all. Rental income computed from a house in Canada, deposited in Canada, later on remitted to India. Remitted to India is not relevant for us to determine Indian income or foreign income. That's where we'll tax only for ROR. Next, interest received in London from Government of India. Since it is Government of India, this becomes an Indian income. Royalty from a non-resident company received in London for a business outside India, we will tax only for ROR. Past foreign untaxed income earned and received there brought to India, this is not an income. So the answer is not taxable. Next one, interest on savings bank deposit in Bank of India, Bhopal, which is in India, so we'll tax for all. Next, share of income. What is that line, my dear friends? Share of income received in India from partnership firm in Dubai. It is received in India, so we'll tax for all. So that is the story of this interesting question, guys. Ready, comfortable and easy. Next, from the following particulars of Anand, for the year ended 31st March 2027, compute his total income for tax year 26-27. If he is ROR, RNOR and NR. Short-term capital gain on sale of shares in Indian company received in Japan will tax for all because it is shares of an Indian company. Next point. Dividend from South African company received in South Africa, we will tax only for ROR. RNOR will tax only in two cases: business income controlled wholly or partly from India, professional income which is set up in India. Rent from property in UK, deposited in UK bank, later on remitted to India, will tax only for ROR. Dividend from SK Limited Indian company, we will tax for all because it is dividend from an Indian company, which is definitely regarded as an Indian income. Agriculture income from a land in Madhya Pradesh, this is exempt. So we will not tax for any person. Getting clarity, friends? Excellent. Next question, guys. The business of HUF is transacted from India and all the policy decisions are taken here. That means definitely it is a resident. Aryan, the Karta, was born in Mumbai and has been settled in London since 1999. And they never told he is Indian citizen. He visits India for 95 days every year. Determine resident status of Aryan and HUF. 95 days every year means in 7 years he is there for 665 days. So he cannot satisfy additional conditions together. But he can definitely satisfy second basic condition. So he will become RNOR. And for that matter, HUF also is RNOR. Because HUF to become resident, additional conditions must be satisfied by Karta only. That's it. Next. Sachin. Next question. Sachin settled in Australia in 1990. Compute his total income for the tax year 26-27. When he settled in Australia since 1990, he will definitely be a non-resident because he cannot satisfy any of the basic condition given under section 6.2. See here. Fees for technical service rendered in India, which will definitely become taxable. Interest on savings bank deposit in Indian bank, that is also taxable. Interest on Australia development bonds, 50% received in India. So 50% is only taxable. Dividend from Indian company, it is always regarded as Indian income. Profit from business in Nagpur, since business is in Nagpur, that is also regarded as Indian income and will be taxable. Short-term capital gain on sale of shares of an Indian company, since it is sale of shares of Indian company, that is also taxable. Agricultural income from a land in Punjab, this will be exempt. Rent received in respect of property at Bhopal, this will be taxable. Very, very comfortable and easy questions, easy concepts. So the whole thing you have to keep in mind is very clearly that first determine residential status, whether ROR, RNOR or NR. Then decide whether it is Indian income or foreign income. If it is ROR, we will tax both. RNOR, we will tax Indian income, and foreign income will tax only in two cases. What are two cases? Business income controlled wholly or partly from India, professional income which is set up in India. Non-resident will tax only in respect of Indian income. That's it. That is the story of this beautiful and wonderful concept known as residential status and scope of total income. High probability that a question will come in examination for 4 marks, which is generally very, very common. So please be cautious, please be careful. That's it.